work on any sign of a sell-off. Why would it be different this year?
Yeah, so we don't think it's going to be different this year. In fact, typically within a 12-month period, we do see about a 10% correction. So we think that that is possible this year. We do think that, we saw some really strong growth last year. The S&P 500, I should specify, is up 35% over the last year. And we just think it's probably time to take a pause there, and that would be an opportunity, not necessarily to buy more large caps, because we're already overweight large caps, but potentially to broaden out exposure into things like small caps and potentially even emerging markets.
This is just amazing. The biggest bear on the street. We might possibly, maybe, see some weakness. Maybe.
We're not bearish.
I mean, I'm not bearish. You call me a bear is ridiculous. So here's my question. Is this ultimately a valuation story? Or are you actually seeing weakness that people aren't recognizing, whether it's in companies or in consumers?
Yeah, so one of the things we have been pointing out is that the equity risk premium right now is very unattractive relative to bond yields. So valuations are high, absolutely. But, experience teaches us that that doesn't necessarily provide us with a good timing tool. So although valuations are high, they could go higher. So it can persist, especially if equity investors think that earnings growth has upside risk, which is what we think we're seeing right now. Does mean, though, that we think that stocks are increasingly priced for perfection. So that increases the chances that we could see a pullback on some disappointing news.
Does that mean that you're increasing your exposure to bonds? You say that there's probably a better risk premium placed on bonds, and I'm looking right now at investment-grade credit spreads at their tightest level going back till November 2021. That still is more attractive?
Yeah, so we do think that bonds at 4.2, 4.5, 4.6, if we were to see that range, that's a good entry point for the long term. We are not necessarily adding to our bond positions at this point. Instead, we have already overweighted short-term fixed income, and we think that that will provide some additional cash to go into riskier assets, somewhere down the line when the opportunity looks more attractive.
Tracy, we were talking a few minutes ago about all this concern from a few months ago about issuance. We're going to see massive issuance. Who's going to be buying all those bonds? Has that disappeared?
I don't know that that has necessarily disappeared, because we are still running budget deficits. So there is still the need to fund those budget deficits. What did change was that the Treasury was issuing on the front end of the curve more so than the long end. So if they change their duration, if they change their maturity, then we might start to see those rates rising a bit. Our forecast for the end of the year does reflect that. We think 4.5% is a reasonable point to end the year. So yes, there could be some yield pressure from issuance, but at the same time, if the Federal Reserve does start to weaken or start to pull back on its quantitative tightening, then that could offset some of that as well.
Tracy, we tried. Thanks for being with us. Appreciate it. Tracy McMillan at the Wells Fargo Investment Institute. It's all relative, just not as bullish as everyone else. I guess it's bearish. Do you know what the most bullish forecast on the street was on the S&P at the end of last year? 5,200. It was John Stolfus of Oppenheimer. Do you know what we closed at yesterday? 5,241. Everyone's been playing catch-up through the year. And this has happened even with fewer rate cuts priced in than what we were looking for. And you remember what the story was. I know this, keep beating on the same drum, I understand. But at the end of last year, everyone was saying, this is the rally based on rate cuts coming. And we were looking for 6 or 7. And we might not even get the 3 that the Fed is looking for based on the economic data we've seen so far. And yet everyone's upgrading stocks.
And just to put a bow on it, Savita Subramanian of Bank of America, you've asked her every time she's been on, What's the biggest risk for you? Downside risk or upside risk? Still upside risk. And that's still where we're at.
What did Bob Michael say at JP Morgan?
Upside risk.
Upside risk. Mohammed, when was the last time you saw it like this? This environment, this market?
It's been a long time.
Bob said the mid-2000s.
Right.
As you reflect on things over the last few decades, what does it remind you of?
So it does remind me a little bit of mid-2000s, but there's also other things that I don't want it to remind me of.
A couple of years later?
Yeah.
Yeah, are we there, though?
No, not yet.
Doesn't feel like it. You say yet.
Yet.
Are you thinking we might be?
So people get carried away. I mean, look at the behavioral issue. Momentum is your friend, momentum is your friend, momentum is your friend, until it's no longer your friend.
Yeah, I don't like benchmarking to extremes, and I know you don't either, so I'm not saying that in 2 years' time we have anything like that, but where would you look for pockets of maybe things going a little bit too far?
So I go back to Anne-Marie's point, is that you need the fundamentals to continue to be positive. Not fully supportive because there's so much liquidity in the system still, but to continue to be positive. And then let's not forget, there's all these other things. If you were to bring someone to talk about geopolitics today, they would paint such a depressing picture.
Yeah.
And they would argue that there is no way that what happens in geopolitics stays in geopolitics.
The S&P 500 this morning, just about unchanged. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackett. Hey, Yahara.
Hi, John. Shares of Lululemon are lower in the pre-market after the athletic clothing maker forecast a lower than expected sales outlook for the year. Plus, the retailer says visits to stores in the U.S. slowed in the first quarter and shoppers are buying less. Lululemon has had a stellar post-pandemic run and analysts are sticking with it, predicting it will outperform its conservative guidance. FedEx shares are rallying in pre-market trading as the company's cost-cutting measures help deliver better than expected earnings. The courier is in the process of restructuring the company's delivery networks, part of a sweeping plan that includes shrinking its workforce by tens of thousands of jobs. FedEx also plans to buy back $5 billion of its shares. Also in retail, Nike warning investors sales will take a hit later this year, pushing shares lower in extended trading. The world's largest sportswear company says it's working to realign merchandise to better match what shoppers actually want to buy. Nike says revenue and earnings sees revenue and earnings growing next fiscal year despite the slump in the first half of the year. It expects to see a payoff from a $2 billion cost-cutting plan announced back in December. That's your Bloomberg Brief. John?
Yahara, thank you. We'll talk about some of the retailers up next. Up next on this program, a softer consumer.
What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable.
That conversation up next.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Ross,
yes.
I've seen that, yes.
Huge controversy.
They used different colours on it.
And I think different...
Was that Nike too? I think that was Nike, right?
That is Nike, yeah.
And they're refusing to recall it.
They think it's modern.
Oh, they think it's modern.
But the politicians are getting into the act right now.
So the politicians going to intervene?
They have intervened.
And what are they going to do?
They've expressed their opinion.
Okay. And is that consequential?
I'll leave that up to you.
Can we return to markets?
Yes, what was the question again?
The question was, Mohammed, after the week we've had so far, I can do it again. Let's talk about the week so far. This is not scripted. BOJ's hiked, S&P's cut, Federal Reserve with a pretty interesting news conference. What stood out for you?
I think what stood out for me is that central banks took a significant dovish turn. And I think that is something that is not just cyclical, I think it's secular. And we're going to be talking about it for a while.
I want to just double down on this point that John was drawing out of you. If you haven't seen this since the mid-2000s, what takes us to 2007, right? I mean, not to sort of benchmark to cataclysmic events, and not, but there is this question of if it's an everything rally and people feel like nothing can fail, that can lead to difficult moments. How likely is that?
So you need a big shock. You need a really big shock, either an economic shock and or a political or geopolitical shock. On the economic side, I think we started to hear it. The consumer is driven by 2 things: net savings and income. Net savings has a orange light or yellow light flashing on it. Income is a green light. So if the labor market weakens significantly and income becomes an issue, then that would be something on the economic side. On the geopolitics, you can imagine something that drives oil up to over $100 a barrel. That would be a big shock.
Well, why is all this discounted? There's two hot wars. 90% of the American tech giants, their chips are manufactured in Taiwan. There's so many different areas or pockets around the world that are brewing with tension, and it's not playing out in the markets.
So let me tell you a story. 2008, the beginning of 2008, a really respected banker comes and sees me, and I ask him, where are we in the cycle? And he draws an upside-down U, and he says, near the top. And I said, what's your risk position? He said, fully risk on. I said, how could you be fully risk on when you're near the top? He said, 3 reasons. I don't quite know where the top is. 2, everybody's also full risk on. 3, I can get out in time. That bank had to be saved. So I'm just saying that the attitude of the markets is that you never know where the top is. You don't want to miss out. You're being judged on a high-frequency basis. And there's this almost arrogance that we can all get out when it matters. So it can run for a very long time.
So the final question then, Mohammed, should be, and I want to jump in because we've got 60 seconds left, that's your experience at PIMCO. PIMCO in that time became the cash machine because you didn't get into trouble. What were you identifying, which goes back to Lisa's question, what did you identify at that time that made you take a very different position in markets?
So, PIMCO tends to be early, and it certainly was early on the housing call, but it stuck to its guns, and that's the advantage of being a long-term investor, and in the case of PIMCO, having clients that have been there a very long time. Now, other firms don't have that confidence of taking a longer-term view that PIMCO has, and that's been the magic that Bill Gross really wired into the system through structure.
Mohammed, this was fascinating. I'm going to go home and re-listen to a lot of these conversations. Appreciate it. And if you want to hear from more from Mohammed, you can on Bloomberg.com. In his Bloomberg opinion column.
On Tuesday.
And I've heard something's coming out Tuesday morning.
Yeah, your column.
In the print edition of the FT.
Yeah.
Only available in the City of London. Is that true?
No.
Maybe it's not true. You can get it elsewhere. In Northern England as well.
Yeah,
That's good.
it's true.
Good to know. Great. Coming up, Sarah Hunt of Alpine Saxon Woods, Kim Wallace of 22V Research, Sophia Drossos of Point72, and a whole lot.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen.
Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
This is Bloomberg.
The everything rally is likely to continue for a little bit longer.
I think stocks can continue probably to do well, high quality stocks though.
The winners themselves, when momentum is high, can continue to do well.
There's still very much a speculative fervor within the market.
We've been bullish, we remain bullish. We still, very much seem to be in this sweet spot.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
One last one for Bramo. Let's get you to the weekend.
Thank you.
Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance. I'm with you. This week is fat exhausting in this market in a major way. Equity futures on the S&P 500 negative by 0.1%. 4-day winning streak on the S&P 500. If you're just joining us, welcome to the program. Here's a flavor of the last 2 hours. Bullish. I mean, seriously. Really bullish, really constructive. Let's start with Bob Michael at JP Morgan. Bob Michael comes on the program. So bullish on almost everything in fixed income. We ask him a very blunt, straightforward question. When was the last time you were this bullish? He sat there, he thought about it, and he said the mid-2000s. We asked Mohamed El-Erian about it, same question, reflected on it a little bit, said the same thing.
That question that you asked, really, to me, is the theme of the morning. How far do we have to go back before we start to see this type of all-encompassing bullishness? Yes, there might have been consequences down the line, but it took long enough for people to make a whole lot of money in the meantime, and that seems to be where we're at.
You hear things like that, and it makes you feel uncomfortable, but it's been upgrade after upgrade on Wall Street on the S&P 500. We had another one from SocGen, Manish Kabra, taking year-end price targets from 47.50 out to 5,500. U.S. exceptionalism is going from strength to strength, despite widespread market optimism. We view this as rational rather than excessive. This is not a bubble. This is not a bubble. How many times have we heard that in the last few weeks?
Which brings us to the Max Kettner note of HSBC, where he's talking about this is not a bubble. To me, it raises this question, and he answered this. There's a lot of early cycle types of behavior in terms of economic strength, different corporate cycles that he's observing. Where are we in this cycle? We thought we were late cycle last year. Now all of a sudden we're early cycle. That, I think, is infusing the optimism, feeling like this has a lot more to go with money coming out of all spigots.
What Mohammed said, I think, was really important. He said, you speak to financial market participants at the moment, it's overwhelming, just overwhelmed by happy talk whenever they talk about financial markets. Speak to an expert on geopolitics, he said, you'll have a very, very different conversation.
Very dark. It's very different than the optimism momentum you're seeing in the equity markets and the markets overall. When you look at geopolitics, Jonathan, and it's a good point to bring up today because we do have Secretary Blinken in Israel, there's two hot wars right now in the world. And any one of these can also have a huge impact on commodities, which have a huge impact on inflation expectations. But then, of course, you look back at the tech darlings of the United States. 90% of them, when they get their chips, is exposed to Taiwan. And that is obviously brewing tension in the South China Sea with China.
The problem is that none of it's really panned out, right? And it hasn't worked for the market. And so it raises this question, are we essentially going to become increasingly fragile as we keep, going with the momentum until something happens that we cannot predict and that we cannot plan for? So that's why I'm still hiding in a bunker.
Well, right now, not much is happening.
Oh, phew, she's bearish
I have to say,
again.
I said earlier on as well, very close. We're getting closer. Lisa is almost bullish. Equities right now, but still in a bunker. right? Kind of.
Always.
Sure. Equity futures on the S&P down by 0.2%. Yields lower by 3 basis points, 423.55. In the FX market, dollar strength against the euro, 108.16. Just about holding on to 108. We're negative on that currency pair by 0.4%. Coming up this hour, Sarah Hunt of Alpine Saxon Woods on the Fed-fueled rally. Kim Wallace of 22V Research as Congress races to avoid a government shutdown. And Sophia Drossos of Point 72 on the Fed's path forward. We begin with our top story. The Fed-fueled rally, pushing stocks to fresh all-time highs. The S&P 500 hitting its 20th record so far this year. Not even tech losses led by Apple or Alphabet curbing market momentum. Sarah Hunt of Alpine Saxon Woods saying this: the Fed meeting this week seems to have confirmed that the central bank is also on the soft landing path and gave markets enough to imply that even with elevated inflation readings in 24, the path is still open for lower rates. Sarah joins us now for more. Sarah, just how constructive have you become after what you heard from Chairman Powell this week?
I think it's difficult not to be constructive given the fact that you had this. So first we had it in December of last year, right? We had all this concern about a hawkish Fed in August and into October. And then in December, they basically said, or Chair Powell basically said, you know what, we think the risks are balanced. He had a chance this week to come out and say, you know what, we think that there's been some, irrational exuberance or over enthusiasm, and he didn't. And I think that that just says the Fed is comfortable with where things are going now, sort of overlooked the higher inflation readings in January. That has to be positive for equities. If the path is still lower, and not only is not higher, we're still saying it's lower. We're not even saying we're not going to do it. The fact that we didn't go to 2 from 3, that might change this year depending on what happens. But in the scheme of things, I think that that was pretty much an okay, go ahead and keep buying things.
We've labelled this week the Everything Rally. We've been buying almost everything, not just things, including banks. Banks are up this week on the S&P by something like 5%. What are they rallying on?
So I think on the bank side, I think that there was this issue that happened in March of last year with Silicon Valley Bank. I think what the banks are realizing is that even though we keep hearing these really dire commercial real estate stories and really dire stories about you've got this big refunding and we've got all this debt has to be termed out, I think that there's a realization that the odds are that if something does go wrong, there's going to be a backstop for it. And I think that that makes people feel better about banks. Now, that's not been explicitly said yet, but I just think if you take the totality of the evidence, that the odds are that you're going to get something done if you see some sort of a crisis in commercial real estate, which we do keep hearing about. We keep hearing the valuations are lower and people have extended and pretended. But the fact that you've got private credit being able to do that may just let that be less of a crisis than we were all expecting.
So does this basically mean that there are other areas as well that could really benefit from the Fed put that essentially you're saying is implicitly being thrown into the market in a massive way that you're kind of leaning into?
Well, I think that that's where you switched. I think that in August and September of last year, you were worried that the Fed put was gone, and now it seems that the Fed put is back. And I think that it's hard to argue against that, right? It's the don't fight the Fed idea of where they're going, then markets are going to follow. I can list a whole bunch of things to be worried about, but you're right, a lot of them are not playing out. And the global political scene is a disaster. And so there's plenty of things that could happen, but could is not, I see a line and I see a time and I have a catalyst.
How much are you doubling down? How much have you actually shifted allocations and bought banks, bought riskier credit, bought everything after that meeting?
I think the answer is more, what didn't we do when things were ugly, which was sell those things? So you keep those things, right? So it's not like you had to double down into technology because we were already there. And we saw some of the things that happened in 2022, but even in August and like when the market cracked last year in September, October, just not shifting out of things and trying to get into the safer bets at that point would have been a more difficult thing from a performance standpoint as you came into 2024, because December happened and that market just hasn't really looked back. I mean, it's had a couple of little Phillips, but it hasn't really looked back.
It's been amazing since the end of October. It's just been a phenomenal run in this equity market. I think we've had 3 weeks of losses since the end of October, and 2 of them were the previous 2 weeks, and we've taken it all back this week and some.
What was that statistic, that a third of the days that the S&P has traded has been at record highs? Just to throw that out there. I thought that was pretty amazing.
20 record highs so far this year.
It's just phenomenal.
It's just been absolutely amazing. We caught up with Goldman Sachs earlier this morning. Goldman said, look elsewhere. Get away from the dominance of the concentration of US equities, big cap tech, look to Japan. What do you say to that?
Well, I think, it was interesting when the Bank of Japan changed their policy and the yen didn't do what people had expected it to do. So that's positive for their stock market, right? Because if the yen had strengthened too much, then people get worried about the currency movements. I think that it's fine to look outside, but you also have to be careful, because if anything is going to derail the U.S., it's going to derail outside too. It's not going to be the U.S. goes down and the rest of the world says, okay, everything is great, even with these massive valuation discrepancies. So I think that there's room for other things, but you have to think about them as all kind of working together.
I just want to frame that a little bit more tightly. Are you saying the US can decouple from the rest of the world, but the rest of the world can't decouple from the US?
Yes. That wasn't how I was framing it in my mind.
Well,
but
I'm
yes,
just thinking that through.
That's
so
basically,
is it always the obvious bet just to own US equity risk if you want to own any equity risk at all?
From our standpoint, it's very difficult to think of not owning U.S. equity risk. You can add other things to it, but especially as a U.S.-based investor, it is very difficult to think I'm going to swap out of the U.S. and go to other places just because I'm worried about the valuations in the U.S.
All right, let's stay on American exceptionalism. We've been talking about how long we can have this privilege to keep borrowing endless amounts of money while also fueling our economy through that kind of financing. Does the Fed pivot make you less optimistic on longer-term bonds, the question John was asking earlier, because it does sort of imply a bit of a higher inflation target and a bit of more tolerance by the Fed to price instability?
Well, I think that what it does is it means that you're not going to go back to zero interest rates. So that gives bonds a place in a portfolio. It gives bonds a place in a portfolio, especially if you have a demographic that's older. You don't want to only be in equities because there is that risk there. And I think that the bond at this point has less risk to it because of the Fed's dovishness. But you also, are long-term bonds going to go a little bit higher because the economy's better? Or are they going to go a little bit higher because they're worried about the U.S. financial system? And I think that this is the joy of having the reserve currency, is that you have a lot more room to act within that than a lot of other countries do.
One thing that Mohamed El-Erian was talking about was that the one place where you're seeing inflation concerns is in real assets, in particular gold. How much has this turbocharged your enthusiasm for things like oil, for things like metals, for things like gold?
Well, I think, I've always had a little bit of a predilection for gold. Most clients don't like that, so I can do that more personally than I can in other ways. But I think that, there is an argument for debasement of global fiat currencies coming out in other places, and that will come out in things like gold. It will come out in things like commodities. It will come out in things like the coins that we don't talk about. It will come out, people will put a view on that by buying things where they feel like there's a difference than just the fiat currency. But again, the U.S. having the reserve currency makes a huge difference in how we can act, and other people can't do that. And even if it is a race to the bottom, the U.S. still ends up in a privileged position.
We noted 2 all-time highs on Wednesday in that news conference. One was stocks, the other was gold. Gold, I think, is really notable. What's happening there in the last few weeks?
And the fact that this might be the inflation hedge, or the concern about, as Sarah was just saying, the debasement of fiat currency.
Sarah, good to see you. Thanks for catching up with us. Sarah Hunt there at Vampire Saxon Woods. Equities at the moment doing okay. All-time highs coming into Friday, down just a little bit. Equity futures negative by 0.1%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Ending the fentanyl crisis is shaping up to be a high priority for voters ahead of the U.S. election. A recent Bloomberg News Morning Consult poll sees about 8 in 10 swing state voters ranking the problem as an important factor in deciding their vote. That's more than the number who cite abortion, climate change, labor, or the wars in Ukraine and Gaza. Fentanyl has been linked to more than 250,000 deaths since the start of the pandemic. And FedEx shares are rallying in pre-market trading as the company's cost-cutting measures help deliver better than expected earnings. The courier is in the process of restructuring the company's delivery networks, part of a sweeping plan that includes shrinking its workforce by tens of thousands of jobs. FedEx also plans to buy back $5 billion of its shares. And BlackRock is calling a Texas decision to pull $8.5 billion from the asset manager's funds reckless. The Texas Board of Education says BlackRock's involvement in environmental, social, and governance, otherwise known as ESG, makes investments ineligible under state law. This is one of the biggest actions taken against BlackRock as states with Republican leaders push ahead with an anti-ESG campaign. BlackRock denies any wrongdoing and says the company holds more than $320 billion in energy investments, including in Texas-based companies. That's your Bloomberg Brief. John?
Yahara, thank you. That story, it's just the beginning. This has been brewing for a while. Saw it a little bit in Florida, seeing it in Texas. not going away anytime soon.
It's not, and it's actually just going to ramp up, especially as we head towards the November election, Jonathan. What you hear from companies is it's really hard to decipher how to do business, whether it's a blue state or a red state.
Going to get harder and harder. Up next on this program, Congress racing to avoid a shutdown.
Democrats have repeatedly made clear that we will find bipartisan common ground with our Republican colleagues. Under no circumstances can we tolerate a government shutdown.
If market participants had a list of things they didn't care about, is this one at the top?
Yeah, the market shutdown that never happens, or
Right,
that if it
just
does, it doesn't matter.
Right up there. That conversation's up next. This is Bloomberg.
Talk about it.
Equities pulling back just a touch. We're down 0.1% on the S&P 500. Into the bond market, yields are lower by 5 basis points on a 10-year, 421.78. Under surveillance this morning, Congress racing to avoid a shutdown.
From the very beginning of this Congress, Democrats have repeatedly made clear that we will find bipartisan common ground with our Republican colleagues. We're prepared to do it once again in order to make sure that the final 6 appropriations bills are passed and on a path to be signed into law. Under no circumstances can we tolerate a government shutdown.
Here's the latest this morning. Lawmakers racing to vote on a $1.2 trillion bipartisan spending package, which would keep the government funded through the end of September. House Speaker Mike Johnson once again facing opposition from within his own party as the GOP majority is shrinking further with the early departure of Congressman Ken Buck. Both chambers have until midnight to get the bill to President Biden. Kim Wallace, Washington policy analyst at 22V Research, joins us now for more. Kim, this might be the shortest segment ever because market participants look at this and just sort of glaze over and they're like, really, again, this? Do we need to care about this?
No, you don't.
Let's move on. Kim Wallace at 22V Research, thank you very much for joining us.
Thank you and good night.
Why is it so much easier now for this speaker than it was for McCarthy?
Oh, I think because we're nearing the election and he's got a shrinking margin, as you've noted. But more importantly, as Tom Cole, the chair of Rules Committee, said 2 or 3 weeks ago, the deal that was cut in May 23 on top line spending has been substantiated 4 or 5 times now since then. So you roll all those together. There's no play here.
What about October 1st?
You know.
Something to worry about.
So we'll get there again, but you have bigger things to worry about in the market. The previous 2 segments, is it growth or is it a head fake? And if it's growth, do we have to worry about what that means for policymakers and fiscal policy? Yes and no. Not now, but in December we go through debt ceiling again. That's when you begin to pay attention to Washington. December, not before.
So if it is growth, what do they do between now and the election?
Tread water. There has been rising bipartisan agreement on the U.S.-China competition front. So yesterday we saw the House pass 393 to 24, legislation that would require a review of all ships at U.S. ports to check them for cybersecurity risk, because those ships and much of the cranes on those ports were built in China. So, you know, we've got substantive stuff going on, but that's not what gets the headlines.
And what about Ukraine? Because that has still been a stalemate.
Slowly, tortuously, they're headed toward where they've been for the last 6 months, providing assistance to Ukraine and Israel.
You talk about how they're bigger fish to fry, in particular, the sort of bipartisan effort for the U.S. to compete with China. I'm wondering if we're having a cohesive kind of policy shift here, or if it's kind of just ad hoc, throwing things at the wall to see what sticks and what sounds good, but doesn't actually come together in something that businesses can really plan around.
Lisa, it's a good question. We'll have to answer it next year after the election, because the U.S.-China competition generates a lot of noise, but it also points to a lot of deficiencies in the U.S. manufacturing base. Shipbuilding, chips. We've got defense industrial base. Deputy Secretary of Defense Kathleen Hicks 2 days ago addressed defense industrial base and how far behind we are. Chief Naval Officer almost a week ago said, you go through history, nations that can build ships, have navies, have commerce. It's connected. We're behind. We're way behind. We were #1 in shipbuilding 1975. We're 19 now. It matters. And it will matter more as we have the great power friction.
A lot of people point to the fact that the U.S. is on the bottom of the list in terms of industrial spending more generally, even with the recent spending packages that have been approved. I'm just wondering, though, how much more appetite is there, as well as capacity for this country to borrow more, to invest more, as so many people are basically betting on in markets?
So Washington is going to have to start multitasking. But after the election, yeah, I know it's scary, but it's real. They're going to have to decide the path forward on fiscal policy that also includes a pro-growth stance. We did it in the early 90s. We reduced deficits just as we were having desktop publishing or desktop computing coming from Microsoft. It helped the boom of 1990s. It's in front of us now. We have technology that could be bleeding edge, that might be applicable across many sectors. And we have a fiscal problem. Those are just votes. Those are decisions on the way forward. That doesn't do away with the challenges you have geopolitically, nor the deficiencies that we've had across our industrial base that make those challenges worse.
It begs the question, why are we going after our national champions in the United States? Why aren't we supporting them? Why are we going after the likes of Apple?
The short answer, John, I think, is maybe we would have 20 national champions instead of 7. If we had better competition in that space. That's not a view, that's just what you hear from some of the competition policy analysts.
What was your reaction to the DOJ's case unveiled yesterday?
It's been brewing for half a decade, and given the DOJ's press release, they seem to think they have a very strong, multi-layered case. The courts will decide. It cannot be that we've had these fantastic tech companies for the past 20 years, and increasingly their network effect has resulted in power for them in the market, and that not stunt competition. The question is, has it been illegal?
The chief antitrust head under the Trump administration, Makan Delrahim, he had notably said that these technology companies are, quote, digital gatekeepers, very similar to what we hear out of this current DOJ. What do you expect? Where can this all go, basically, if we get Trump back in the White House? Or do you think this stays the same?
Anne-Marie, we don't know. If Trump is back in the White House, you have to ask the question when he's back in the White House, and you have to ask it almost every day, because he changes his mind based on how he feels on topics and based on with whom he speaks and their interest.
You said wait until the election, and I was sitting here thinking, right, do we need to wait until the election? Don't we know what both stand for on these issues? And isn't this administration quite similar to what we saw from the former administration on a number of these topics too?
I like the first half of that, in that we are nearing in this country a very stark choice. I would push back strongly in a long time that they're very similar. In trade, you see some similarities. They're protectionist, but if you look at the strategic level, it's different. Whole of government versus rifle shots.
Give us an example of that.
Well, the tariffs, both on steel and agriculture. That was the brunt of the U.S.-China competition under Trump. When he was about to ban ZTE and Huawei technology and hardware from the U.S., he was contacted by people in the U.S. who knew him, who had positions in those companies. He backed away, similar to TikTok. So it's strategic versus what you feel like at the moment.
But the Biden administration kept those tariffs in place, and Trump is weighing potentially even more aggressive tariffs. 10% wall overall for the world, and more than 60% from China specifically.
True, but when you look at geopolitics or even trade, those tariffs are a very small part of the overall story, very small part. And the two men approach that question very differently.
What do you think the approach is going to be regarding China in the near term then, specifically for Biden, regarding EVs? I think this is a really important topic. What happened over the weekend, a lot of news organizations went for this headline about bloodbaths, and I think the story for us was actually the president, just before that, the former president talked about a 100% tariff on Chinese EVs. The former president talks about tariffs. The current president talks about protecting union workers. What do you think he can do between now and November to do just that, attack the same thing?
The current president?
Yeah.
Make promises. And that's all he can do, and see that his Inflation Reduction Act continues to unfold. We have to accept the fact that the U.S. is way behind, and if they're going to compete, industrial base, technology, we'll be talking about this for a decade in terms of the catch-up.
You say promises. What would those promises be?
Promises be that if you re-elect me, I'll double down on boosting the defense industrial base. $60 billion in his first supplemental request. Hicks, in her speech, reiterated that same $60 billion and broke it out. So you have to ask each candidate, what's your plan?
And we will, if they join us, Kim. But as you know, they like joining their own respective TV networks, which is what happens in America quite often.
Thank goodness that opened space for the others.
I know. Kim Wallace, thank you, sir. Kim Wallace at 22V Research. Coming up on this programme, point 72, Sophia Drossos on the Fed's path forward. That conversation just around the corner. Equity futures on the S&P 500, negative by 0.1%. In the bond market, the rally continues there. We're down about 5 basis points on a 10-year to 4.21, and a 2-year, we're down 3 basis points to just about 460. From New York City, this is Bloomberg.
trends in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Let's attempt to wrap up the trading week and give you a flavour of the price action on the session and over the last week as well. 4 days of gains on the S&P 500. Small morning of losses. We're down by 0.15% on the S&P. Negative by 0.3 on the NASDAQ. Both on the S&P and on the NASDAQ. All-time highs at a close on Thursday. We switch on the board and get to the bond market. Snapshot of treasuries for you. 2-year, 10-year, 30-year. Yields down across the curve. More so on the long end, down about 5 basis points, 421.58 on 10s. On 2s, quite a round trip this week, from the 470s on Monday. Lisa, briefly, the 450s through the middle of the week and back up to 460.41.
The Fed puts back. The Fed's got the markets back. That's essentially the message that the bond market keeps taking. We've been asking all week, what about the long end? Does this make sense in the long end, given the fact that there's a tacit understanding that inflation might run hotter for longer, and that's okay? And everyone's saying, we're not really getting a clean answer from anyone.
They are pointing to gold, though. Gold may be just sort of picking up on the scent of that, just a touch.
It seems like there's a wall of money, and this is what people are struggling with. Something that might make sense in theory doesn't work in practice just because there is so much liquidity that people say is looking to find a home. Bob Michael was talking about just people buying more equities, people buying more credit, but the cash balance is still going up. So how do you put this together and come up with some thesis that's going to really play out in markets?
We've said basically anything with a dollar sign this week has done well. I mean, I know that's a stretch, but it's felt that way. Stocks and bonds rallying. $2, strength in the whole of G10 with the exception of the Japanese yen this morning. Yen showing a little bit of strength. Dollar yen down by 31%, 151.16. Stronger on the session, weaker on the week. And I think the week has been the story, Lisa, not today.
They did it. They raised rates to zero. Woohoo! And guess what? And you wouldn't know it because they also effectively say that they're still doing yield curve control. They're just not calling it yield curve control, and they'll come in if they need to. So even though we got a hotter than expected print with respect to inflation in Japan overnight, doesn't matter because the Fed put, the BOJ put, central bank put seems to be back in play.
We've got some time this morning still to build on this, but what Mohamed Al-Erin said a little bit earlier this morning, that just the early signs of a long, long game, but the early signs, the first few steps of maybe accepting a higher inflation rate without actually being mandated one, which I think is going to be controversial in some circles.
But that's essentially what Jay Powell said. He said emphasis on take a while, or the words I'm lost in my head. But my question
long week.
Thank you, yes, long week. There's this question of, how long they will be patient and allow inflation to drift down to 2%. If they allow it to be north of 2% for 10 years, has their target changed?
We'll come back to those comments in just a moment. Under surveillance this morning, some of our top stories for you. Regulators hitting Apple at its core. The DOJ and 16 attorneys general filing a lawsuit accusing Apple of blocking rivals from iPhone software and hardware features. The tech giant losing $113 billion in market value in yesterday's trading. Meanwhile, the EU is preparing to investigate the company over the compliance with the Digital Markets Act. Apple shares down about 11% year to date, underperforming both the S&P and the NASDAQ. AMH, this is the interesting feature of this, and of course there are many interesting dimensions to this story, but typically we were accusing the Europeans of going after the darlings of US tech, and now it's the Americans going after their own babies.
Yeah, it is, and this increase started in 2019 under the Trump administration, so it's been years in the making, and what is so interesting and potentially why you see the stock sell-off is that it is really comprehensive in how much they're going after everything that is integral to the iPhone. It's messaging, how they deal with digital players when it comes to the wallet, cloud services. But years in the making, I think years in the making as well in terms of what is going to be the remedy for this. And there was a briefing call yesterday with the DOJ, and they didn't take off the table this idea of a breakup.
Who wins if the DOJ is successful? Maybe China. Chinese President Xi Jinping set to meet with a group of US business leaders next week as Beijing looks to attract foreign investment. The list of participants isn't complete, but the president of the National Committee on US-China Relations and president of the US-China Business Council are expected to attend. US executives are already heading to Beijing this weekend for the China Development Forum. According to the Wall Street Journal, those names include Apple's Tim Cook and Blackstone's Stephen Schwarzman. This is the charm offensive. And the big data point that I think matters here regarding this story is FDI. And that number is not a pretty one for China.
It's been negative, and the most negative that we've seen really going back decades. There's a real question here of how much executives are going to actually hear what Xi Jinping has to say and how much the executives who are going there are being forced to hear what he has to say because of how much of their businesses are dependent on the China economy. Tim Cook.
Good point. Whether or not they like it or not, do they have to show up? But I was with Xi and Biden in San Francisco. Remember that dinner they hosted? $40,000 to sit at Xi's table. So this is probably going to be expensive as well.
Yeah, they paid up for it. And I think the fact that Tim Cook was in China this week as this was unfolding with the DOJ in Washington kind of tells you what's important to them right now.
They're tied to it from a demand standpoint, and they're tied to it from a manufacturing standpoint. They can't get away from it. How many other Tim Cooks are there? Not as many as there used to be, but it's really a difficult thing to extricate these two economies that are the world's biggest.
Apple, the big movie yesterday. Let's finish on this with Nike and Lululemon under pressure, both anticipating challenges in the US market. Nike warning investors sales will take a hit this year as it recalibrates its merchandising lineup. The company shifting its sneaker offerings to better match customer demand. Lululemon seeing a sales slowdown to start the year thanks to lower foot traffic and shopper pullback. The activewear company focusing on expansion in China as competition rises stateside. So I guess that kind of reinforces the conversation we just had.
At the end of the day, it's a very populated country that has a lot of money. It's where businesses want to be. At what point are they really going to be so hesitant to get in because of the geopolitics when, you know, there are dollar signs there or yuan signs?
Those stocks are struggling. Let's push forward. A slew of Fed speak on deck today. I like that.
Thanks.
Including Fed Vice Chair Powell, Fed Chair Powell, Vice Chair of Supervision Michael Barr, and Atlanta Fed President Raphael Bostic. Sophia Drosos of Point72 weighing in on the FOMC's path forward, writing, quote, "We continue to look for 3 rate cuts this year, starting in June, and continuing at a quarterly pace. The Fed will be cutting rates as inflation falls, but growth remains above trend. That should prove supportive for broader risk sentiment." I'm pleased to say that with us around the table is Sophia. Sophia, good morning.
Good morning. Thanks for having me.
What a week. Mohammed was on the program with us about 30 minutes ago, and he was talking about central banks almost tacitly accepting higher inflation rates. Is that a view that you'd endorse this morning based on what you've heard this week?
Well, what I would say is that central banks are starting to focus perhaps a bit more on other aspects of their mandates, and they're supportive of the idea that inflation has come down, and they are making progress on that front. And so we are seeing policy shift. And what I think is very interesting, I have never seen it in my career, is that central banks are cutting in tandem globally, but we don't have a negative catalyst that's driving it. So for me, it's like central banks are taking out some insurance to help the growth side of their mandate, particularly here in the U.S., and that's very supportive of risk assets.
Do you think this can be explained by some kind of post-pandemic supply-side renaissance that has helped these central banks out and they get to pull back a little bit? Is that what this is?
I think that's part of what it is. Certainly when I listen to what the Fed has been saying over the last few months, and I think Chair Powell put his marker down very specifically in January, saying that the monetary policy is very tight, but we haven't felt the full effects of it in the U.S. economy because the supply side has been shielding us from that. So it's very rare that we see such dynamism on the supply side, and certainly very rare that we see it globally. But something is happening because goods prices are falling across the board in all major economies. And when I look at producer prices and in major economies, they're either in negative territory on a year-on-year basis, or they're relatively flat like they are in the US. So certainly the goods side of the economy and the supply side of the economy is doing a lot of the work for the Fed right now.
Sophia, I want to get into one aspect that maybe got less attention, which was the balance sheet. And a lot of people were looking for the Fed to talk about how they were going to be cooling off on some of the balance sheet roll-off. They still are going to do that, even with stocks at record highs and bonds continuing to rally. Have they really drained liquidity from the system that seems to be just absolutely chock full of liquidity?
Well, I was looking at this last night because, as you know, the Fed balance sheet data come out on Thursday. You're a nerd on the balance sheets. I know that you know that. Okay. And what's interesting is the Fed's balance sheet was about $4.5 trillion pre-pandemic. We got up to $9 trillion. The Fed has done some QT, but the balance sheet is still very large, and certainly the supply of money seems like it's much higher than what one would have expected to be supplied by the Fed in sort of a normal environment. So we're still dealing with a lot of liquidity, and I think with regard to QT, the Fed is being very smart about it. They've learned some lessons from 2019, where they continued at a relatively aggressive clip, and eventually this led to some frictions in the money markets and prompted them to very abruptly end QT and start QE. So what they're doing here, I think, is slowing the pace, means they can go for longer, and it probably means that QT is less volatile for financing markets.
So basically, you put this all together. The Fed is being very cautious. They want to support the economic cycle. You have fiscal spending that keeps pouring in to support some of the technological advances. Just as you advise investment professionals at your own firm, what's to say this is not early cycle and can keep going for a long time, and that the rally, even if it's getting to higher levels, has legs?
Yes, of course. Again, going back to what I said earlier, I've never seen a cycle where global central banks are cutting in tandem and there isn't a negative growth shock. So it is a very positive tailwind, I think, for growth expectations. When I think about it in terms of the global economy, it seems to me that the way that central banks are acting in unison is reducing the risks to the global economy. It should be raising people's expectations for global growth. And we should start to see these pockets that are more tied to the global beta, the global cyclical cycle, start to percolate a bit more. And I think that's why you're seeing that Japan is still a very heavily subscribed trade. Europe as well. Italy is one of the best performing stock markets year to date. I think that would surprise a lot of people.
Not this guy.
Not this guy. He's into Ferraris and banks, I guess. That's what the MIB has. But in general, I think that it is a very positive global growth environment. So in that sort of context, it's not surprising. People have got cash on the sidelines. Every Thursday, I look at the money market assets, and they don't decline measurably. So there's still a lot of cash on the sidelines. Central banks are taking out some of the downside growth risks, and it looks to be a more positive outlook.
The story. We talked a lot about the story in the last 5, 6, 7, 8 minutes. Can we talk about the price of the story? How relevant is the price of the story? Does that matter at this point, given how strong the storytelling is so far this week, and how justified that is too?
Well, I think it does matter, right? And I think that's one of the reasons investors might be looking for catch-up trades. And again, if central banks are perhaps giving us a little bit more assurance on the growth side, it is giving some investors the opportunity to look for value. So that was one of the initiating catalysts, I think, for Europe and Japan for their equity markets to start to catch up to the U.S. And now we're seeing it in other pockets as well. We're starting to see a bit more interest in small caps and in value. And I was looking at the screens this morning, the Russell 1000, the S&P 1500, those are all moving in tandem with the S&P.
I saw this Wednesday. We were talking about it, the outperformance of the Russell on Wednesday as Powell was talking in that news conference. As you said, people are itching for catch-up trades. Are there some trades that you advise people against taking, some catch-up trades that maybe you think won't evolve in a desirable direction?
Well, in this kind of environment, I think a lot of things look pretty good, right? There's a lot of positive outlook in terms of growth expectations. Inflation's coming down, and I think this is one of the reasons you're seeing the everything rally. It's, I think, very hard to differentiate. The tide that rises all ships. We're seeing a little bit of that, but pricing could be an issue for some investors. And again, I think this is one of the reasons people are looking more for catch-up trades. Where can I find good value? Where can I see an opportunity to see a bit more of a catch-up to what's happened in the S&P?
There's been a bit of a debate on the show this morning. Do you go outside of the U.S. or do you stay with the U.S. because a lot of this growth is being driven by U.S. exceptionalism? Peter Oppenheimer of Goldman Sachs saying, go elsewhere. What's your view on that?
Well, I think typically when we get to a Fed cutting cycle, historically, the dollar has trended lower. And I look at the starting point for the U.S. dollar, and it seems quite strong to me. If you look at it on a inflation-adjusted basis, we are at the levels we were in the 2000s. And so currencies do mean revert over time because investors' expectations for growth in other parts of the world will also catch up to the U.S. And as we see that, we could see more capital flows and allocations to other parts of the world. I think also, too, the U.S. still has a current account deficit, about 3%. Not extreme by historical standards, but still something that we need to finance, whereas other economies are in a current account surplus position. And in some cases, they're seeing their surpluses start to expand, like in Japan, in places like Brazil. So I do think that this global environment gets investors to look outside of the U.S. for sure.
Sophia, this was great. Got to do it again. Thanks for being with us.
Okay, thank you.
Sophia Drossos there of 0.72. Equities right now on the S&P, negative by 0.1%. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hakes. Hey, Yahara.
Hi, John. Bitcoin is set for one of its worst weeks of the year as ETF demand weakens. The token has pulled back more than 10% after touching all-time highs over $70,000. Bitcoin ETFs are also on track for their biggest weekly outflows since trading began back in January. A net of $742 million have left the funds from this Monday through Wednesday. Reddit rose 48% in its trading debut yesterday, with the social media company closing at more than $50 a share, well above its IPO price of $34. Investor enthusiasm for the listing, driven by the company's pitch to profit from the growth of artificial intelligence. Reddit's IPO is the fourth largest on a U.S. exchange this year. At market close, the company had a market valuation of $8 billion. Tesla is reducing electric car production in China amid sluggish sales and intense competition in the world's largest auto market. Sources telling Bloomberg the company instructed employees at its Shanghai factory to lower production of both the Model Y sport utility and Model 3 sedan by working 5 days a week instead of the usual 6.5. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, regulators hitting Apple at its core.
It's a white-knuckle period, no doubt, that Apple's going through. But my view is that after, call it 1 to 2 quarters, they get onto the other side of this with a pent-up upgrade cycle.
You know, I've got the transcript for that piece of sound in front of me, and I was reading it, and I knew it was Dan Ives before I even saw his name. Just white-knuckle ride. It's just sort of like
leather jacket,
Dan Ives-isms.
Rockstar.
Yeah, all of that. That conversation is up next.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The opening bell, 42 minutes away. Equities pulling back just a little bit. We're down 0.1% on the S&P 500. The bond rally continues. Yields lower by 5 basis points, 421.58 on a US 10-year. Under surveillance this morning, regulators hitting Apple at its core.
It's a white-knuckle period, no doubt, that Apple's going through. But my view is that after, call it 1 to 2 quarters, they get onto the other side of this with a pent-up upgrade cycle. And I believe it's all right now about AI. You do not want to be selling this stock into AI coming to Cupertino. That's why this is, in my opinion, not the time to throw in the white towel.
Well, people are selling this stock. Here's the latest. The DOJ suing Apple for alleged antitrust practices over its iPhone hardware and software. The company also expected to face a probe in Europe as part of another crackdown on big tech. The news putting pressure on the stock, down 11% year to date, underperforming the S&P and the NASDAQ. Joining us now, Bloomberg's Mark Gurman, an Apple guru. Mark, let's get into this. What is the defense coming from Apple in the last 24 hours?
I mean, the defense is essentially that the DOJ lawsuit is littered with nonsense. They make 5 central points, and 3 of the points they make against Apple are things that have either already been resolved or things that Apple said would be resolved. So there's a lot of confusion as to why the DOJ is making allegations against Apple about issues that have already been rectified or in the process of being rectified. The suit is filled with technical inaccuracies related to things that Apple may have done or is doing. And, you know, Apple believes that the DOJ is throwing as many items as it could gather against them, but none of them prove that the company is a monopoly. None of them show that Apple is harming consumers. To me, what you see here is Apple harming some app developers and partners. The major 2 pieces that seem relevant are the inability to create third-party tap-to-pay payment applications in the U.S., and the way the company sort of throttles third-party smartwatches when they're paired with the iPhone. So I think this is not going to be a couple quarter type of situation. I think this is going to be a 3-4 year situation where ultimately you see the DOJ adjust their case and maybe narrow in on some specific items. You see a back and forth between Apple and the Department of Justice. What you've seen in Europe in recent quarters, where you've seen the Digital Markets Act and Apple making tweaks to the iPhone operating system to fit those new requirements and make some changes there, I think you're going to see the same thing happen in the U.S. to some extent. I would imagine that Apple is going to pick items one by one and rectify what actually could be changed and sort of try to come to some sort of settlement here, whether this is a fine with the DOJ for past behavior, and then those tweaks to iOS. I think that's going to be able to get this over with, but it's going to take a few years.
This sounds incremental, Mark. This doesn't count catastrophic. Does this justify some of the sort of existential fear that seemed to come through the market yesterday at a time when everything else was rallying?
I don't agree with the stock sell-off related to existential fear about this DOJ case with Apple. I can make a far better case of why you should sell your Apple stock that has absolutely nothing to do with these DOJ allegations. There are obviously AI features coming soon. Apple has done little to nothing to prove to the consumers and to the marketplace over the last decade plus why anyone should trust that these new AI features will be impressive or on par with what you've seen from competition. I think there are concerns about Apple's next major new hardware category. I think the cancellation of the self-driving car is a massive disappointment and underscores some serious innovation-related problems at the company. So fine, you can sell your stock. I just think you probably sold it for the wrong reasons.
Mark, Mark, I'm glad you mentioned AI. The Wall Street Journal is reporting that Apple held preliminary talks with Baidu to put their AI generative technology on devices in China. We have Tim Cook in China right now. Was that part of also potentially the defense when it comes to the US DOJ?
Yeah, I don't think the two have to do with each other. I reported last week that Apple's artificial intelligence plans includes a combination of in-house AI, which is not the more advanced generative AI that you're talking about, and then the other piece of it would be partnering with an outside AI company. They've held talks to license Gemini from Google. They've held talks to license ChatGPT from OpenAI. They've held talks with Anthropic. I reported all of that last week. And for China and for other markets, you probably need a more localized AI player, and that's why you see the conversations with Baidu. It's the same, whereas in the US and many other countries, you have Google as the default search engine, but in China, you have Baidu. And that's because obviously Google's not operational in China. China's a big market for Apple, and if you want the generative AI features to work in China, you're going to need a local partner. And so that's why you see these conversations happen with Baidu.
Mark, I'd love to finish on your latest article in Business Week. You and a couple of colleagues worked on this one. I just want to go to the third paragraph, first couple of lines of it. This year, the Magnificent Seven has looked more like the Magnificent Two, the Middling Two, and the Meth Three. Mark, what's changed this year compared to 2023?
Well, Apple in particular is under a lot of pressure. I would not put the DOJ specifically in that category. I would put regulation as a big category of its own. They have suits in almost every country you can name off the top of your head, with the U.S. being at that top of the list. Obviously, the 27 nations that make up the EU. You have Australia. You have countries in Europe, not within the European Commission. Definitely, this car thing, I think, is a major disappointment. What is the legacy for Tim Cook to hang his hat on in terms of a major new product, when he eventually steps down? I mean, spatial computing, the Vision Pro headset is cool, but does that have the potential to be a $100 billion category like the car could have been? And again, like I said, Apple is the creator of Siri. They've had 10, 15 years. Who's to say their new AI is going to be great either?
So true. Mark, thank you, sir. You're one of the best. Appreciate it. Mark Gurman there of Bloomberg. Just about got enough time for a final thought, Bramo. What a week.
Everything rally. Just have to say, this idea of mid-2000s, that really sums it up. And we heard that from Bob Michael and then reiterated by Mohamed El-Erian.
But Mohamed El-Erian said, where are we at the peak? If you look at that upside down U, by this banker that had to be bailed out, said to him, we're in the peak, but then came the financial crisis.
Equities right now on the S&P 500 negative here by 0.1%. The opening bell just around the corner. This was Bloomberg Surveillance.
Welcome to a special Miami Open update for Bloomberg TV and radio from Tennis Channel. Former Australian Open champion Caroline Wozniacki is packing her bags after Anhelina Kalinina fought back from a set down to reach the second round. The Ukrainian saved a match point in the second set before wrapping up the victory 6-4 in the decider. She'll face either Aryna Sabalenka or Paula Badosa for a spot in round 3. And don't forget, Tennis Channel's daily live coverage starts at 11 a.m. Eastern.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrow. So the euphoria of a 20-day rocking rally on the S&P 500 is momentarily interrupted. Let's see what the next 30 minutes do. FedEx's bid, we're keeping an eye on red, at up 48% yesterday. For the moment, a little bit of bloodletting after a monster rally. The countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up in the show, a busy week for global rate decisions boosts investor sentiment. The equity rally takes a small breather as stocks flirt with the best week of 2024. And from Nike to FedEx, the latest earnings provide more insight to the U.S. consumer. We begin with a big issue. Fed Chair Jay Powell giving a rally the green light.
He had a chance this week to come out and say, you know what, we think that there's been some, irrational exuberance or over-enthusiasm, and he didn't. And I think that just says the Fed is comfortable with where things are going now. It's difficult not to be constructive given the fact that you had this. So first we had it in December of last year, right? We had all this concern about a hawkish Fed in August and into October. That was pretty much an okay, go ahead and keep buying things.
So let's just reflect on the 5 days and a little bit more Fed speak today. Mike, good morning. What have we got?
Well, we've got a question about how we topped this week. That's one thing, because we had a lot of central bank action, the Swiss making the biggest news of the week. But here's the good news and the bad news. Next week, we'll have a major couple of news events. The PCE inflation numbers that will drive the Fed, and Jay Powell taking questions from NPR. But they're both on Friday when the markets are closed, so you're not going to be able to trade on those. Instead, what you get is today you get Jay Powell any minute now, not going to be making any news. It's opening remarks at a conference. He's going to welcome people to the Fed. And then Michael Barr talks about international monetary design, and Raphael Bostic talks about household finance. No news there. Same thing on Monday, Bostic with equitable development. Then Lisa Cook comes in and talks about, the Fed governor talks about the dual mandate, so there will be some news there. And then Chris Waller, who everybody wants to follow, is doing an unusually late New York Economic Club dinner at 6. Usually they're at lunchtime. The economic outlook, that'll get a lot of attention. That'll be the last big trade of the week. The only real numbers we have are some on housing, so it's not going to be a big week for that sort of thing. Right now, what we're looking at is the market's still almost in a tie between July and June for which is going to be the first month for a Fed rate cut, and we still have those 3 priced in with September and December on board as well. But the question, Manus, is a week from today, we aren't going to know where we are because nobody's trading, but if we go a week and a day, back to a week from Monday, will we still be where we are today? Will there be enough news to change Wall Street's mind, or can you all focus on Reddit and things like that instead?
Well, it's always good to get distracted by Reddit. And don't forget, you can always trade Bitcoin. Next Friday, it is one of those markets that's open. There you go. Mike, thank you very much for setting out the agenda. My guests this morning say this. Morgan Stanley's Jim Caron weighing in on the markets and the reaction, writing this. They unleashed animal spirits by signaling tolerance of higher inflation, while at the same time upgrading the growth expectations. Jim Caron, Jen, Subhadra Rajapaksa join me now for a discussion. Jim, let's take it straight to you. They've unleashed the animal spirits. So 9 basis points down in the bonds, 20 record highs in equities. I mean, this is a fairly punchy week for risk. Do you just not fight the Fed and embrace this next evolution of bullishness?
Well, it's a great question. Thank you for having me on your show. Look, the most impressive data point for me this week, yes, the Fed was important. Yes, it's super interesting that equities are making new all-time highs. What's most important to me, or what's most interesting, is that 10-year Treasury yields actually didn't go up. They actually went down, despite what would be thought of as somewhat inflationary, somewhat very pro-cyclical, pro-growth, where the Fed is running growth rates above their potential estimates. So they've got growth expectations of 2%, over 2% over the next 3 years, yet their potential GDP is 1.8. They do expect inflation to come down, and the market's believing it. If you look at 10-year break-evens at about 2.34%, the market's basically saying that, yes, the Fed has long-term inflation credibility, that they're able to run the economy a little bit hot with no consequence of inflation. So the fact of the matter is that the back end is actually the 10-year yield and beyond is actually believing this, and it's keeping rates low, and that's really what's unleashing the animal spirits. The equity market's just following along. It's a dutiful soldier doing what it's supposed to do in an environment like this.
The dutiful soldier, the equity boys and girls out there might have something to say to you on that. Subhadra, good morning. Good to see you in the house. You made a beautiful synopsis. You talk about this is the Fed nailing the landing, the soft landing, and that the markets have been quick to recalibrate. 9 basis points down in the 10-year government bond yields. What scale of recalibration is that? It's not huge, but it's a direction of travel, isn't it?
Yeah, absolutely. Coming into the meeting, I think there was uncertainty about whether the Fed is going to suggest 2 rate cuts for this year or 3. They stuck to the 3, and the market quickly recalibrated to that on the very front end. But broadly speaking, to me, the bond markets are in some sort of a limbo. On one end of the equation, even though, as Jim pointed out, you have an environment where the Fed is supporting the economy, and that should potentially lead to higher growth and higher long-end yields. There's no clear catalyst for a meaningful rise in yields from here on, like we saw back in August, September, and October of last year, when the Fed was leaning a little bit more hawkish, and they were thinking about potentially hiking rates again at the December meeting. And on the downside, really, again, because of the strength of the economy, it's been a struggle for bonds to really rally meaningfully from here, because you really need to see the data break meaningfully for yields to decline. So we're sort of in a tight range, I would say somewhere between 375 and maybe 450 if you look at a broader range. And it's really going to be hard for bonds to shake out of that range meaningfully over the near term.
I was listening to Larry Summers yesterday on Wall Street Week, and Larry had this to say, that he warned that it was bizarre that they had a neutral rate of 2.6%, only an inch higher than where we have been given the growth levels. Let's just listen to Larry.
Still, that the Fed is itchy fingers to start cutting rates, and I don't fully get it.
We've got unemployment, if anything, below what they think is full capacity. We've got inflation, clearly even in their forecast for the next 2 years, above target. I don't know why we're in such a hurry to be talking about moving towards the accelerator.
So, Jim, any sympathy for Larry there? And I do listen to Larry Summers. He just wonders, not that they're trigger happy, but that we're in such a haste to get these 3 cuts done.
Yeah, so I have a lot of respect for Dr. Summers, and I think he's very, very smart. But I do disagree with him on this one point. I think what the Fed is really weighing is that they believe that policy levels are very, very tight. If we look at inflation, let's call inflation 3%. The nominal Fed funds rate is 5.5%. That means that you have a 2.5% real policy rate. That's very, very high, which means that the Fed is very, very tight. And the risk to the Fed is that the economy could fall off a cliff because their policy is so tight right now that the wheels can come off the cart very, very quickly. If they stand by and do nothing, the unemployment rate could potentially shoot up very, very high. And that's what I think they're really making a trade-off on right now. And that's the battle that the Fed is fighting. So I don't think it's as simple as Dr. Summers is putting it out there. I think the Fed is really worried that they are very tight and that things could slow very quickly if they sat by and did nothing.
So, Badra, do you think that the real rates are very tight, and that is a justifiable reason to comprehend and accept the 3 cuts that are penciled at the moment?
Yeah. So I do think that real rates are high. You look at 10-year real yields around 2%. But really, the point is the Fed could take one of 2 tacks, right? In the past, what they've done is they've kept policy restrictive for a lot longer, and they've been slow to cut rates, leading to potentially a recession. This time around, they're basically telling us that they want to orchestrate a soft landing, and they are very focused on growth, they're focused on employment, and they're ready to act if needed. And that's really the difference in the messaging, I would say, this time around in this cycle, where the Fed is much more keen to nail a soft landing than in past cycles, where they've let interest rates stay higher for a lot longer and then cut aggressively when the U.S. economy actually goes into recession. This time around, they don't want to see the economy going into a recession.
I want to get a quick response from both of you on markets. I know that you say the volatility is going to be interesting over the next couple of months, Badra, but this is investment grade and high yield. The money has been piling in. It's the first positive inflows, sizable inflows, since the start of 2019. And junk spreads are at a 26-month low, the tightest since 2007. If they're trying to nail the soft landing, do you still believe in high yield, or is it IG over high yield? So, Badra, briefly.
Yeah, no, I think that spread products in general look very, very attractive, right? I think when you start going out the risk spectrum, you've got to be a little bit more selective on what kind of credits you want to put your money to work. But broadly speaking, I think IG as well. IG spreads are very tight, but on an absolute basis, you're getting very good returns in investing in credit. So that's really where the money's going.
And Jim, for you, lower quality credit is still attractive for you. You're not worried about the default. Is it more about coupon than default?
Yeah, it's more about coupon than default. So we're overweight the high yield space. We're underweight the investment grade space. Investment grade yields right now yield about 5.35%. It's below cash levels. You're taking on a lot of duration risk for not a lot of extra yield. The coupon level in high yield is somewhere in the high 7% area. Yes, spreads are tight. Yes, we know that. If we get a soft landing, then I would argue that default risks are going to be a bit lower. So the way that we're doing is we're barbelling it. We own high yield and then also high quality front end treasuries. We have a lower duration but higher yield, less interest rate sensitivity in the portfolio, and that's the way that we're positioning.
Okay, team, stay with me this Friday after the Fed. Jim Caron, Subhadra Rajapaksa, more work to do. I'm going to give you a quick snapshot. A few other stocks that are moving. You've got to keep an eye on FedEx. I mean, it's a buyback of $5 billion, and that is what has given us a 10% lift there. Tesla is down. Again, more discussion around lower potential Chinese output. And Lululemon Lululemon, I should say, drops by 13% ahead of the opening bell. Abigail Doolittle is with me to take us through some more detail on these stocks. Abby.
Well, Tesla is down on the day, as you mentioned, Manus, and this, of course, after they reduced car production at its China plant amid slowing EV sales growth and competition from China EV makers. On the week, though, these shares are still set to be higher. Nike, not so much, down 6%, also heading to a down week. Feeling the heat from the likes of Hoka. Sales for the upcoming fiscal year are to be in the low single digits versus the 4% estimate. And the CEO saying big adjustments are ahead. Lululemon down nearly 13%, or down more than 13%. They also reduced their full year sales view, so that growth of 11 to 12% is well below the 19% of last year. This as traffic at U.S. store sales slows. And then FedEx, well, that is clearly the one bright spot there, up 11%. They beat adjusted earnings, but there was a small sales miss. And then, as you mentioned, investors really loving that $5 billion buyback, up about 11% in the pre-market.
Okay, Abby, we'll get to the sectors a little bit later on. Coming up, the latest earnings provide more insight on the U.S. consumer.
What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable.
Soft and stable. That's what we like about the consumer. We'll dig into Nike and Lululemon in a little bit more detail in just a moment on Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
A year ago, I would have said resilient, 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 resilient. I mean, there was nothing. What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable. They're softer and they're staying there.
Two retailers begin to put stock back on the shelves and some more information for us. Nike and Lululemon both delivering what could be called cautious outlooks to the shifting landscape for the consumer. The Nike CEO says this: we know we're not performing to our potential. It's clear that we need to make more important adjustments. What are those adjustments that he's prepared to make? Poonam Goyal joins me now. Poonam, this was a bruising day of reality, really, about what's called competition for Nike.
Yeah, you're absolutely right. You know, it comes back down to product and innovation. And I think both Nike and Lululemon, what they talked to us about last night was that they need more innovation. the reason for some slowdown in Lululemon's first quarter sales is because they didn't have the right product. Similar with Nike, they talked about bringing innovation back and really pushing the pedal harder on it. They have faced increased competition, so they need to up their game.
And on Lululemon, I mean, the issue is this. It's very interesting. It's about footfall, isn't it, into various stores versus the online and the international position for them.
Yeah, absolutely. You know, traffic has been a challenge for U.S. retailers in general, but Lululemon has largely bucked that trend over the past few years. The softness that we see in traffic, we think could be temporary for them as they add more innovation and the right product back into stores. I think that was part of the reason why conversion was also light at the retailer earlier at the start of the quarter. So we do think that there's opportunity here. Plus, keep in mind, you know, the real challenge here is the conservative guidance that we've heard from both brands. And that's not something new. We've been hearing that all quarter from other brands as well.
Okay, it's only going to have an impact and a reverberation around the retail space. Poonam, thank you so much. Bloomberg Intelligence, Poonam Goyal on the retailers. Bank of America had this to say about the consumer. Further support for lower income household spending continues to come from elevated bank deposits, including households with income less than $50,000. The monthly median savings and checking balances is around 40% higher than it was in 2019. Jim Karen, Subhadra Rajapara, my guest this morning. Subhadra, that surprises me. This was the team were down at Bank of America earlier this week. And that really did surprise me about that underbelly of strength. Everybody's come in here and told me about the dissipation of savings, the dissipation of COVID money. Would that surprise you to read that kind of fact?
So there has been a dissipation of savings over the last couple of years. There's been a lot of fiscal stimulus coming in after COVID. A lot of that has gotten whittled down. But that said, almost every, we have an unemployment rate that's 3.9%. Almost everyone in the U.S. has a job and they're willing to continue to spend. So really the savings rate is coming down, but as long as they have jobs, there's a willingness, broadly speaking, for investors to spend. But ultimately, what you are seeing in the U.S. is kind of a haves and have-nots economy, where the cohort that's 40 and under is coming under a lot of pressure. You're seeing rising credit card delinquencies. It's the same cohort that's having to pay up student loans, auto loans as well, and they're also not able to buy homes because of the fact that borrowing costs, broadly speaking, are higher. Rents are high and sticky, so they are whittling down their savings, but not as fast as people expect.
Yeah, and is that housing element that the Fed are going to be particularly interested in when it comes to assessing the shelter component? Jim, if it's possible to have a walk away from Nike and Lululemon, you could extrapolate that this is an indication that maybe prices may have topped out, maybe that price gouging will have stopped, and that has a trickle effect potentially in the back half of the year on pricing, CPI, and inflation.
So it gets back to what I was saying earlier, which is that effectively what the Fed is worried about is if we get a rapid rise in the unemployment rate, that is going to have a much, much bigger and broader impact on the retail sector, housing sector, and other sectors. And that's what they want to kind of stop. So what we're observing right now is that wages are coming down. The employment market is cooling, but it's not collapsing. Now, the miracle that we're witnessing at this point is that inflation's been able to come down, but the unemployment rate really didn't skyrocket higher. The Phillips curve would tell you, and this is the model that the Fed uses, is that when you get inflation coming down as much as it is, then you're likely to get an unemployment rate to start to move higher. And that's what's really concerning at this point, where if we do start to slow down, if there is some tension in the jobs markets where the jobs market starts to weaken and wages start to fall more rapidly, you can see it. You would see an unwind of a lot of the positive news that's been propping up equity prices and the markets in general, and that could happen very, very quickly. So I think the walkaway, or at least the takeaway here, is that we're skating on thin ice a little bit. Now, as long as things continue to move, and as Subhadra is saying, people have jobs, wages, everything is okay. As long as it's a soft landing, I think we get through the cycle just fine, but it's risky.
Look, of course it is. I mean, we had that interruption, didn't we, in January and February in the data. So, Badra, can I close off just with the jolts that we had this week from the SMB and from the two hawks on the Bank of England throwing in their call for higher rates. I'm looking at the gilt market. You know, it's on fire. These other global bond markets, we could, and this is a question I asked my guest yesterday, we could have this syncopated rate cutting cycle beginning in June. Everybody has a different end point. From a global perspective, do you think we're moving into a new evolution globally in bonds?
Yeah, no, the global bond market is definitely very, very correlated. The expectation coming into this year was that the Fed is going to be the first to cut and all the other global central banks will follow suit. And really the weakness in the US has just not materialized. So you're looking at an environment where the ECB has moved up its timing for rate cuts and looks like the Bank of England might as well. And the Bank of Japan is getting ahead of that and trying to get out of negative interest rate policy. So you're looking at an environment where the US is continuing to outperform, and you're seeing that play out, broadly speaking, in the timing of when the Fed might potentially cut rates. So we are in a situation perhaps that other global central banks might get ahead of the US when it comes to cutting rates.
Okay, Subhadra, thank you so much for joining me this morning. Subhadra Rajapal, Jim Caron, my guests on the markets. Coming up, your morning calls, DWS's Group's David Bianco joins me at the opening bell. We're going to discuss this equity market rally and the road ahead for the Federal Reserve right here on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We got to Friday. This is what the street makes of some of the big names. We have JP Morgan upgrading Best Buy to overweight, seeing better growth dynamics, easing deflationary headwinds. Redburn upgrades Verizon to neutral, pointing to strengthening subscriber trends. And finally, Citigroup upgrading Foot Locker to neutral, expecting the retailer to benefit from Nike's new strategy for wholesale products. Coming up, we have DWS Group's David Bianco with me to discuss 3 rate cuts penciled from the Fed and 20 straight records in a row on the cash market. Will that endure? The futures at the moment are pointing perhaps we're about to break the trend. Good morning from New York.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends, we're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Are we running out of steam on these equities? We've had 20 records in a row. Lululemon plunges domestically here. The business under pressure. Tesla also down as they're potentially going to cut production in China. So for the moment, 5,300, big round number. Right now, this market has exhausted itself for the week. But let's see how we finish at the end of the day. Some other asset classes for you. Rounding out a pretty big week where the Fed has indicated they will cut 3 times. That gives you a bond market. There is no barrier to entry here. 420 is where we trade. We're down 6 basis points. We've moved overall down by about 9 on the week. The Bloomberg Dollar Index, you're looking at the dollar actually on the week up 0.7%. It's set for its best week in 2 months. So again, the steadying of the nerves and the rate cuts, etc., and the uplift to growth has emboldened the dollar. Bitcoin, I just thought we'd give you a flash there. Again, down over 2%. At one juncture, we were down 10% this week. This has been the worst week for Bitcoin of 2024, and it still looks overbought, according to JP Morgan. Tesla's down by 3%. It's certainly one of the stocks we will dig into. When it comes to what to watch, we've got athletic retailers Lululemon and Nike, both under pressure, posting disappointing outlooks for slightly different reasons. Abigail Doolittle is with me to differentiate.
Well, on the surface, both of these retailers put up pretty good quarters, Manus, but beneath the surface, not so much. And right now we have Nike falling to its worst day since December. Lululemon down 14%, the worst day since March of 2020. So that's the degree of selling pressure. Starting out on that one, they beat again on the quarter, but the sales outlook is seen as being pretty cautious. $10.7 billion to $10.8 billion. That's the range for this year. That's growth of 11% to 12%. When you compare that to last year of 18%, it's just not cutting it. This stock now down sharply on the year. On Nike, they are feeling the heat from some of the new running sneaker companies such as Hoka. They warned that sales will fall to the low single digits this year, this fiscal year that starts in June. Analysts had been looking for a 4% rise in the first quarter, 6% rise in the second quarter. CEO Donahue is saying that there are important adjustments ahead. This as they shift away from some of their more classic styles. Both of these stocks, Manus, now down 10% or more year to date.
Yeah, we're just looking at Lululemon. I'm just looking at this, down 15% at the open. That's the biggest drop since 2020. A brutal day there. Abby, thank you very much. Turn to the biggest, well, the newest public company, I should say, not the biggest. Reddit shares coming back to earth this morning after successfully debuting on the NYSE. It is the 4th largest US IPO this year. Ed Ludlow is with me from San Francisco. Ed, I mean, this was stellar. 70% on the open, 48% up on the close. It's just a moment of redressing the balance.
Yeah, I mean, I wrote about in my column today on Technology Daily that they got their AI story right. And I think coming out of the one-day listing, or day one of listing, that's what people are talking about. We're pulling back 3% day two, but this is still a company based on the shares outstanding, valued at $8 billion, fully diluted basis around $9 billion. That's lower than its last private round in 2021, which was a $10 billion valuation. And it's going to be interesting in the days and weeks ahead to see who played the IPO. So, for example, we know that Cathie Wood and ARK bought Reddit shares for 2 of their exchange-traded funds. 8% of the offering went to Redditors themselves without any lockup or restriction. But there are some lockup and restrictions on some of the longer-term shareholders. How will that play up in the next few weeks and months? And I go back to that AI story. You know, it's everything that the executives wanted to talk about, but it's a very nascent business. And I just reflect in the column, and I'm giving myself a shameless plug, but go and read it on Tech Daily, that if you look at the listings of the last 6 months, whether they are a social media platform like Reddit, an AI-adjacent story rather than a true pure-play AI story, they're talking it up, and in the first instance, investors buy it. There's no real sell-side coverage yet on Reddit, which you'd expect, but I would note that the New Street Research cautioned that the FTC is already probing the Reddit business to license its data for the use in training large language models. And while they think that that will have a muted impact, it could slow down the pipeline of deals with other AI companies that want to harvest that data. So it's been a fun week, Manus. Happy day 2 post-Reddit IPO.
Indeed, indeed. And it is expected to grow by 20% this year, as you say. They face some of the challenges in dealing with our data when you are a contributor on there. We're looking forward to your daily newsletter. Ed Ludlow there in San Francisco. Let's turn our attention to the EV market. I just said to you at the open, Tesla stock was having a tough day for the second day. We understand they're going to reduce production in China due to slowing sales growth and intensifying competition. Alex Webb is with me. It's almost like a weekly laundry list of either price cuts, factory outages, union angst. Alex, contextualize growth of EVs in China overall. I mean, this is about competition from BYD at the very heart of it.
Yes, not just BYD, but a range of other Chinese EV makers as well. The Chinese market, actually, unlike much of the rest of the world, is growing at a fairly healthy clip, 17% or so. Tesla itself is shrinking. The first 2 months of the year, Tesla's sales in China fell by 6%, according to numbers released locally. About half of the output of this factory in Shanghai goes to the Chinese market. The Bloomberg reports from its sources that the production is going to go from 6.5 days a week to 5 days a week. The thing that's interesting about this is it seems to herald a bit of a strategy shift. Last year, when Tesla started to see this weakness in the EV market, it started really pushing discounts in order to drive its numbers up. Don't forget, Tesla massively expanded its capacity in recent years with new factories in Berlin, in Texas, and of course in Shanghai itself. In order to fill that capacity, it really started discounting in a big way. This might signal a bit of a pivot, that they are instead looking to cut costs, cut some of their production costs. If that extends to other facilities as well, that would be very interesting and something investors would have to take on board because it heralds a different kind of strategy.
Okay. Alex, thank you very much. Alex Webb on the Tesla move. Let's pivot to FedEx. They're recording the biggest rally in over a year, and this is all on the back of a $5 billion share buyback program, cost-cutting efforts that are beginning to pay off. Simone Foxman is with me. This is a battle between current delivery and future promises on cuts, isn't it?
Yeah, I mean, really, this was meant to be a verdict on FedEx's broader cost-cutting plan, and analysts really cheered by what they're seeing so far. Remember, this plan meant to restructure the delivery network. They've lost about 22,000 jobs in the last year or so. Efforts to turn around the express business. Analysts largely saying this delivered, and when we dive into the numbers, we'll see earnings topped expectations by 40 cents, coming in at $3.86 a share. Revenue Revenue, however, slightly short of expectations at $21.7 billion. That all of this, though, despite some weather-related disruptions back in January. Raj Subramaniam saying, we are making meaningful progress on our transformation. He said there were permanent cost reductions of $1.8 billion. But analysts, despite this rally we're seeing today, flagging some concerns. Morgan Stanley pointed out potential earnings quality issues. Jeffrey said volumes were softer than expected in the ground, even though that's really the way the business is moving. But we are seeing gains here today on an intraday basis. This stock up the most since March 17th, 2023, Manus.
Go FedEx. Simone, thank you very much. Well, stocks are poised for their best weekly gain of 2024. DWS's Group's David Bianco weighs in on the rally saying this. Last week, we raised our S&P 500 price target to 5,300 as it's parenting AI. This includes a 15% premium for superior growth potential of digital stocks. David, good morning. Good to have you with me.
Good morning.
There's no doubt about it. There's an sense of exuberance, 20 records in a row. Contextualize what you think AI will grow at. I was looking at what UBS are saying. They expect 18% earnings growth in tech-related stocks this year, and over the next 5 years, about 70%. Does that lay perhaps the firmest foundation of all for Mag 7 and tech in general?
That's right. So AI is real. It's going to help the S&P grow. It's going to help the economy grow. We're still wrestling with valuations, and wrestling with valuations always requires some degree of consideration of interest rates. So what a week it's been, because we've got the Fed on one hand and AI, the theme, the stocks, still reigning supreme. We do think that we're going to see earnings growth out of the S&P 500 this year and next year. We're not very worried about a recession anymore, but we're still of the view that overall earnings growth for the S&P will be about 8% this year and next year. And that is with tech and digital stocks, the AI stocks especially, doing more than 20% earnings growth this year and next year. The valuations expect every bit of that. And if longer-term Treasury yields go up, then the valuations become even more demanding. So we've got a Federal Reserve that is signaling that it's patient about inflation coming down to its target. We'll see how patient the long-term bond market remains about that. Those who want to be optimistic about inflation solving itself, or even the deficit solving itself through productivity and the supply side being strong and pointing to things like AI, I would say to you, look, even if you believe in AI, these things take time. They'll play out over years. And what you've got going on in the equity market is tremendous wealth creation on rapid PE expansion, on the promise of what will come in the years to come.
So then,
Yes?
let's just pause. There's a lot to unpack there. So
that's right.
So much then is front-loaded, isn't it? It's on the presumption of future
That's
earnings.
exactly right.
That's your job. Your job is to presume where the earnings are going to come from. But if tech is so front-loaded, is that what leaves you at a 5,300 call for this year, relative to some others? For example, SocGen at 5,500. There's a few other outliers up there, but that seems to be the top of where it is. Is 5,300 a conservative call for you? Are you playing catch-up?
We are playing catch-up. We've been keeping up thanks to good stock selection strategies overall, and our portfolio managers doing a good job of it. But we've been a bit cautious on the macro front from a combination of demanding valuations, and not everything's exactly rosy outside of the tech and digital AI world. That said, it's hard to get ahead in this market without taking even more concentrated bets on the leadership and the momentum that's dominated for so long. That's the situation we've been in. We're doing our best to manage around it, point to alternatives. We like healthcare, we like financials, we like small cap stocks. We want to pick out of these parts foreign stocks. Shorter duration bonds are offering still an attractive yield. We're doing our best to keep up with great large cap U.S. equity markets while recognizing that the promise of AI is real, but don't overly count on it, or
it almost sounds like you're fighting with yourself. It almost sounds like you're fighing with yourself in that you're looking for.
And we are. Yeah.
You know, you're looking perhaps at Europe, which is on a magnificent run. Japan, which is on a, I don't even have the superlative for Japan. But are they hedges,
right. We're pointing to those.
Or are they active participatory positions?
They offer diversification, but they also offer attractive returns in our view, and we've pointed to things like Japan and foreign stocks. But it's hard to keep up with the AI leadership. Yeah. And often people come back to us, our clients, and say, that's all great, but what about the Magnificent Seven? What's your view? Our view is overall fully valued. There are still stocks within even that terrific group that we like and some that we're cautious on. But the point is this. I think too many people are saying the Fed gave a green light, but I would argue that the Fed's trying its best to ignore the equity market. And if the equity market continues on this pace, it might be the equity market giving the Fed a bit of a red light, because this wealth creation is what's flying against the Fed's efforts to be restrictive and get inflation down faster, and it should get it down faster. And if this equity market keeps rallying, even if it's right to do so over the longer-term outlook of AI, I don't think that's going to help the Fed in its battle this year or even next year, and I think the bond market's going to lose patience soon.
You know, to a certain extent, the equity market ignored what the Fed said. They raised the longer-term neutral rate, albeit incrementally by a small amount. They penciled less cuts for next year than the market had originally anticipated. They upgraded growth, and they upgraded inflation as well. So who's paid the least attention, the bond market at the longer end or the equity market?
It's hard to do nuance right now, either for me or the Fed or reading the equity market. I agree with you. I mean, if you look at the details of the dot plot, they're trying to signal that they might not cut as fast or as low as previously thought, and that has a lot to do with recession risk diminishing. But no one, is paying attention to those details. The headline has been they're going to cut 3 times this year. Market should rally, but the bigger issue is really is AI, the right valuation, and when do we see that supply side miracle really delivering, not just for these tech companies, but for the economy and the broader corporate world overall.
David, who am I to interrupt a magnificent party on a Friday afternoon? Yields are dropping, equities are merely pausing for thought. David, thank you so much for being with me this morning. Speaking of which, we're going to talk a little bit more about the Reddit IPO.
This whole process has made us a better company, and we're prepared to be a public company. I think it's actually been really good for us.
We'll get a little bit more on that stock debut in just a moment. The stock gives slightly back, down 7% at $47 and change.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have 2 assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
They're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This whole process has made us a better company, and we're prepared to be a public company. I think it's actually been really good for us. And I think companies that, can go public, it's sort of a duty. It's part of the, process of maturing as a company.
Reddit gets a warm welcome from investors. The shares soared at the close 48% yesterday, above their IPO price of the debut, with AI at the center of the social media's proposition and value proposition. The IPO is the fourth largest this year in the United States, and it marks a rebound after two of the slowest years in a decade. We'll bring in Bloomberg's Amy Orr on this story. So Reddit, a great deal of excitement around it. The insiders got to sell a bit of stock, nearly $300 million. It really blew the doors off at the opening, didn't it?
Yeah, it did. And it seems like it's still holding, even though it's giving up some of the gains in pre-market, but it's still well above the $34, which is very important for a lot of people, especially issuers coming forward in the second quarter. A lot of people were just concerned whether Astera Labs is the only exception to the rule, and then whether it's got all the tailwinds behind it, the AI leaning, the microchips and all, and whether Reddit will actually enjoy the same kind of investor reception, and it seems like it does.
What's the pipeline like? I want to make sure that you're busy for the rest. I want to make sure that you're busy for the rest of the year. You've got Instacart, you've had Astera Labs. You've had momentum shifting. Will it hold? How does the pipeline look? What are people saying to you?
So the pipeline has always been strong, given that Reddit has been in the pipeline since 2021, and there are a lot of companies in the same boat. And many of them have been continuing to update their filings to make sure that people understand that they still have the intention to go forward. And there are quite a few of those going forward as well. But the pipeline, even though it's very strong, for the people who can actually go out in the second quarter, it's still maybe a dozen or so. But I have to say, the moment that Reddit traded and by the minute that it held above its IPO price, the pipeline just grew longer and longer.
Well, it certainly gives people confidence, but there's also a dynamic that private equity are perhaps being a little bit more under pressure to give the spoils back to some of their original investors so that they can invest again with more significant size at play. How much of that is going to play into the thinking of those when they go to pull the trigger?
So private equity has held a lot of assets, and they've been kind of stuck with these assets for quite some time. And then in the secondary market, since the beginning of the year, we've seen quite a lot of sell down, which means they really wanted to return money to their own LPs. But the only thing, though, is for private equity assets, many of them have quite a bit of leverage, and that's what investors do not like. They want the proceeds to be used to develop the company for further development, to boost the income and revenue of the company instead of paying their sponsors. We've seen BrightSpring at the beginning of the year. It was the first IPO to come. It was owned by KKR. And it's still, the pricing right now, it's still being kind of hampered by investors' lackluster kind of reception towards it.
Amy, thank you very much. As we see Reddit giving just a little bit back in first flush on the second day of trading. Let's get into the sector price action. Abigail Doolittle is with me as ever, side by side.
Well, on the day, Menace, we are looking at a small decline. The S&P 500 down about 0.1%, helping out to the upside. The communication services sector up about 0.7%. Google higher there. We also have some of the defensive sectors, utilities and healthcare higher. Industrials up slightly. Consumer discretionary, not surprisingly, the worst sector, a big drag, down 1.1% on those disappointing quarters out of both Nike and and Lululemon, I should say, not disappointing quarters, disappointing outlooks. As for the week, it's a different story. All 11 S&P 500 sectors are higher. The index itself up about 2.5%. And communication services, well, that's the best, up 4.7%. Industrials, the second best, up 3.4%. The worst two sectors still higher, up about 0.7% and 0.6% respectively for healthcare and real estate. So some of the breadth that people have wanted to see for the market rally this week, that is certainly happening as all of these sectors participate in the gains.
Abby, thank you very much. Great work this week. Coming up on the show, we'll set the agenda for you with your trading diet. A little bit of Fed speak today.
Of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
This is Bloomberg.
Check in on your trading diary in just a moment. It's worth refreshing our view. This is a break of trend, 20 records in a row. You are just seeing Lululemon down. The footfall in the shops here in the United States is lower than estimated. Internationally, not doing too bad. Likewise, Tesla down. As we understand, they're cutting production. So for the moment, this is bullishness interrupted. In terms of the trading diary, this is what you need to know for next week. Monday is the deadline for Donald Trump's $454 million bond. What will happen? The Milken Investor Conference kicks off on Tuesday. Then we understand how the housing market in the United States looks. The U.S. mortgage applications come in on Wednesday. Thursday, it's Sam Bankman-Fried's scheduled sentencing in New York. And finally, ending the week with the U.S. PCE, all important, and the Fed Chair Jay Powell. The markets will be closed for Good Friday. You can, of course, trade Bitcoin, vicariously trading risk. There's a thought for you. That was Fed Week on Countdown to the Open. I hope you enjoyed it. Do join us next week. We'll leave you with the rest of the team to take you through the rest of your trading day. And Mr. Bostic speaks a little bit later on. We've got it all here on Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, you're listening to Bloomberg Intelligence. Bloomberg Intelligence, BI Go on the terminal, gets you to some of the best research on Wall Street. We've got 400 investment professionals covering 1,200 companies in 130 industries around the world. Equities, fixed income, commodities, we do it all, and we rely heavily on them over the next couple hours in this Bloomberg Intelligence show. Coming up today, we're going to check in with Mandeep Singh. He's a tech dude at Bloomberg Intelligence. I want to ask him about Reddit. I want to ask him about Apple. A whole bunch of stuff going on there. It is Friday, which means we talk to Barry Ritholtz, Ritholtz Wealth Management. Basically, we ask him about whatever he wants to talk about, and then we go. And again, it is Friday, and we talk municipal bonds. So that is going to be some good stuff coming up here. Alex Steele is out today on and she's doing something very important, I'm sure. Michael Regan's sitting in for Alex Steele. Thanks for coming in here, Michael. Michael Regan's Bloomberg News editor over there, so he comes in all the time and helps us out on the radio side. Michael, what are you looking at here this week?
Oh, boy, I'm just checking out the movers in the stock market, Paul. Lululemon and Nike, awful price action there. Lululemon down about 17%, Nike off 8%. So I think we're about to hear a little bit more about why exactly that is.
Yeah, we're going to get Poonam Goyal in here. She's a senior retail analyst, so that's good stuff here. Right now, let's kick this whole thing off with Mr. Nathan Hagen on Bloomberg Business Flash.
And Paul, we're brought to you by IBKR. Investment advisors switch to Interactive Brokers for lowest cost. Global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest at ibkr.com/RIA.
Yep.
It is a Friday. We're seeing a little bit of a breather for the stock market rally, though we are still pointed toward our best week of 2024 after a Fed decision and a hint to the market that Rate cuts are on the way. Andrew Sheets, global head of corporate credit research at Morgan Stanley, says the Fed's message is the right one for markets.
The supply side of the economy is improving, that we're seeing through larger energy production, through increased immigration, more productive capacity, and that allows for better growth without necessarily increasing inflation a commensurate amount. So overall, I think we got a good message. Obviously, markets have responded positively, but I don't think the markets directionally are wrong with how they responded to the news this week.
Andrew Sheets of Morgan Stanley. Right now, markets are kind of on pause with the S&P 500. Little change to the downside, 5240. Right near an all-time high for the S&P 500. The Dow Jones Industrial Average is down about 0.2% or 59 points, trading at 39,722. The NASDAQ Composite, little change to the upside, up 1 point, 16,402. 10-year Treasuries up 14.30 seconds, the yield 4.21%. NYMEX crude is down about 0.2%, $80.92 per barrel. COMEX gold down about 0.25% at $2,200.80 per ounce. The euro a little weaker against the dollar at 1.0828. Bitcoin down 3.3%, 63,300. In fact, Bitcoin's peeled back more than 10% from its all-time high as the appetite for spot Bitcoin ETFs moderates. That's a Bloomberg Business Flash. Bloomberg Intelligence with Paul Sweeney and Mike Regan is on.
Nathan Hager, thank you so much. We appreciate that. Michael Regan sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So head over to YouTube and search Bloomberg Podcast, and you can click on the live link, and there you go. Absolutely unched on the day, as Nathan was just reporting. When you look at the indexes, nothing really happening here, but there's been a heck of a week, the best week so far this year if we hold on to these gains today. So good move, as it seems like the general theme from some of these central banks, most notably the Federal Reserve, is, yeah, we're still dovish out there, so don't worry about it. Let's check and see where the action is under the hood, and we do that with Nora Melinda. She covers all the markets for Bloomberg News, and she's also a UVA grad, and that was just a brutal
Wahoo
play in game for them.
I will stand on it. Wahoo wah.
I love Tony Bennett. He's a great coach, but man, it is brutal to watch his teams play.
We did get kind of... You got beat up a little bit. A little bit.
Come back next year.
Hey, I had Kentucky going all the way.
God.
I don't want to talk. Let's talk about baseball or something else.
Oh,
Right.
man. All right, Nora, what do you got for us?
Well, let's talk about a stock in the green before moving to the dismal end of things. But looking at FedEx, it's surging on plans to buy back about $5 billion of its shares as its cost-cutting efforts are helping to boost profits. It had adjusted EPS of $3.86 that topped expectations, as well as its operating income and operating margin. Those both beat as well. But really what's interesting is that this is the third straight quarter of FedEx's operating income rising despite falling revenue. And as we know, this is all kind of in the midst of the CEO's restructuring plan, which has included shrinking its workforce. And TD Cowen said that the company's cost-cutting initiative is working.
Yeah, I mean, I think the market likes it here. Up 8%. Boy, it's up 13% year to date, up 13% year to date, 52-week high. Trailing 12-month basis, stock's up 35%. So turning things around, maybe.
Maybe so.
All right, good stuff. What else you got?
Got to move to the laggards. I know it's a Friday, but some bad news here. Looking at Nike, looking at some of these retailers, looking at Nike and Lululemon. Nike is seeing its worst day since December. It did put up a pretty good quarter, but underneath, there's not the best stuff going on. The company warned that its sales will take a hit due to competition from new running shoe brands like Hoka and On. I don't know if you guys shop. Have you ever bought Hoka shoes?
No.
See, I have knee problems, and my doctor told me to go get some Hokas. I ended up going with Asics, but I feel like
what kind of knee problems do you have? Dude, please.
I know I'm too young for this.
Yes, exactly.
But my knee used to dislocate, and they said that Hoka is a really good brand if you're looking for rehabilitative.
Your knees dislocate?
Yeah.
Oh, wow. That sounds painful.
You don't want to know.
Hokas have that real thick padding,
They
right?
do.
Yeah.
And so it's really showing that like Nike is really relying on its brands for basketball shoes, maybe Air Force Ones. I own some of those. But it doesn't seem like they're competing as well when it comes to these popular brands that are coming in the space right now.
Yeah, they got to add some more padding to those soles, I guess.
Right. That's
simple. Hire me, Nike. I got your solution right
That's
now.
the key.
Exactly. Yeah, I'm a Nike fan. I guess if I have any brand loyalty for a sneaker, it'd be Nike.
Yeah, I mean, the Air Jordans are just comfortable, stylish, even,
And now some
even
of the
for a guy
sneakers are
my age.
just so light. They make them out of these materials that are just incredibly light.
Timeless.
Yeah.
But it's funny when you compare it to Adidas, though. When you look at the last
Adidas.
12, Adidas, my bad. Isn't Matt the one that says this?
Yes, exactly. The correct way. It's the European way. Although I don't say Kyiv, I say Kiev, but that's not proper Bloomberg, is it?
Geez, you're asking me.
Well, you're the editor.
Am I the proper Bloomberg guy?
But,
but I can spell it. I don't have to say it.
Okay. That's
exactly. The stock is down about 16% over the past 12 months. And if we compare that to Adidas,
yep,
it's gained about 40%. And this is despite, Ye or Kanye and like all the drama with his brand and the Yeezys, but they're still doing pretty well when you compare the two of them together. Nike's not doing too hot.
Did they get rid of all that inventory? I remember, wasn't that like an issue?
That was an issue.
Like, how do you get rid of, I guess you stop your deal with Kanye, yet you're long like hundreds of thousands of pairs of these sneakers all around the world in your supply chain. What do you do with them? I don't know what I think there was a plan a quarter or two ago to discount them and get them.
Slap a new label on them or something.
We need updates.
Make them Drakes. I don't know.
Hey, your beat is real estate, right?
It is.
We had a portfolio manager come in here earlier, pitching REITs in a lower interest rate environment. Are you hearing that from other analysts,
because
investors?
I have been hearing a lot of people saying that when you look at this type of rate cycle, a lot of analysts are saying that REITs tend to outperform coming out of this. Okay. And so although it's pretty beaten down, especially as you look at office landlords and a lot of commercial real estate, people are saying that, they may actually be able to come out on a decent end. And when we look at office specifically, it's not going to be a grand recovery is what I'm hearing most. But, I think it'll be a little bit better than what people are anticipating.
My expectations for office is I'm just baking in a 50% haircut. If anybody wants to argue me off of that, I'm thinking down 3rd Avenue, like just take any corporate building on 3rd Avenue in Midtown Manhattan, 50% haircut.
Well, I think that's what Manulife came out yesterday and said 40% or something like that, right?
Yeah, so that's going to be interesting. So I don't know how you clear that inventory. I see signs up all across suburban areas, rural areas, urban areas.
Yeah.
Every building has a sign in front, space to lend.
Offices and malls, and you can't, some of it you can convert to residential, but really not that much.
Right.
I don't know. Yeah. All right, Nora, thank you so much for joining us. Norma Linda, covering all the markets. Her beat for Bloomberg News is real estate REITs, all that kind of good stuff. But we appreciate her coming in here, giving us an update on these markets. All right, so we've had, I'm going to call it a really, really good week for the IPO market. A-Lab, which is a great ticker. I love that, ALAB for Astra. That stock's up again. IPO'd, started trading Wednesday. Reddit started trading yesterday. It was up a gajillion %. It's down 9% today, giving a little bit back. No big deal there. But I'm going to get into the story here because it seemed like very well received Reddit by the market yesterday, the IPO market. Mandeep Singh joins us here. He pitched me hard yesterday to go in size on this IPO. So I put a 10% order in. I'm not sure if I got anything, but with the underwriters. But Mandeep Singh joins us back here in our Bloomberg Interactive Broker studio. So I guess Reddit is a social media platform. You get a big audience, you sell advertising. We've seen that game before. Big cap ones are the Facebooks, the Googles, the smaller caps are the Snaps and all that kind of stuff. This fits into the smaller cap thing. Why can't they make money on that business?
Well, one, if you compare the user base, it's still of the size of, Snap and Pinterest. But remember, Snap and Pinterest are 3 to 4 times bigger in terms of revenue. So this platform is vastly undermonetized.
Why is that, do you think?
Well, they never had an ad platform to begin with, and they started developing ad tech solutions over the last 5 years.
Oh, okay.
The most exciting thing at the roadshow was really the data licensing business. That's what at least everyone thinks has a lot of potential. They're not going to take digital ad share from Meta or from Google. It's more about what can they do in this unique data licensing business, which if you believe in the Gen AI story, then I think there will be a time when investors will start looking beyond the picks and shovels semi plays, and that's where companies that have unique user-generated data, they will get a lot of attention, and we think Reddit is uniquely positioned. So it's sort of refreshing to see an IPO that goes beyond the semi plays and the hyperscaler, the Max 7 that is getting all the attention, and I think that's part of the reason why you're seeing the IPO do so well.
Well, Mandeep, I wanted to ask you about that. I guess the notion is that a generative AI company will license access to all the posts on Reddit to help AI sort of learn to speak like a human. Although I got to say, from some of the posts I've read on Reddit, I don't know how good of an idea that is with the Wall Street Bets type of post. But how big of a potential sort of source of revenue for that is that for Reddit? I mean, there's a lot of hype around AI. I'm wondering if you can help us sort of really cut through that and figure out how big of a business could that be for Reddit?
Yeah, so the Google license, we know it's about $65 million per year. So if you think at least there would be 8 or 10 large language model companies that will license the data, that adds to, 600 million.
It's not exclusive at all to
at least we haven't read anything to suggest it's exclusive. So that just goes to show that there is a lot of potential in data licensing. And remember, this is like a 95% gross margin business. They don't have to spend any money in terms of rolling that out as a product. So that's one. And to your earlier point about, the quality of the posts and the data that's used for training, I think one of the things with large language models is not only do you need good quality data, you actually need bad data to put the guardrails. So it's something that every LLM company is doing, is iterating to their models, making sure they're putting the right guardrails. And with Reddit, the unique advantage is this is human curated data. This is actual user data, not generated by machines. And obviously with the 1 billion posts they get every year, this keeps, getting updated. So as an LLM company, you want to make sure you have the most up-to-date user-generated data to be able to design the chatbot functionality on top of it. Whether it's good data or bad data, you actually need both, I would argue, because that's how you put the guardrails in. And remember, Reddit is only text, so they don't play in the images or videos. That's more for, the YouTube and the TikToks of the world. So this is a text-focused LLM play, and I think that's where they are uniquely positioned.
And just on that other IPO, again, Astera Labs, ALAB, up about 9% today, third day in a row that it's been higher. So that continues to be a really good story. So 2 good IPO stories this week. Hopefully that can get some of these equity capital market bankers off their fannies and get out there and do some more deals. I mean, that's what I'm thinking. All right, let's switch gears. Apple. I guess the question for a lot of people is, how significant is this latest round of regulatory scrutiny, various suits by various regulators around the world? How material is this to the short, intermediate, long-term investment story for Apple? Is this a 1990s Microsoft overhang, which was not good for the stock? Or is it something that the stock can power through?
I mean, judging by the stock reaction, it did, suggest that this doesn't bode very well for Apple in the near term, given all the attention they're getting, both in the EU and now in the US. And I think one of the things that happens when you come into this kind of scrutiny is you can't make any product changes. You can't do even tuck-in deals. I mean, I can't imagine Apple or Google buying any company. Microsoft sort of is circumventing that by breaking a company apart and, poaching all the employees as they did with Inflection. But it just goes to show that once you are in the crosshairs like this, it's very hard to, roll out a new product without getting more attention. And in this case, the monopoly argument is really geared towards their app store. So we all know that Epic Systems trial has been going on for, 3 years almost. Mm-hmm. And even though Apple have one verdict in their favor, it looks more and more that Apple has to make changes to open up the platform, whether it's third-party billing or other type of changes. And to me, that doesn't bode very well for the services line. Ultimately, that is the high-margin business. And if they have to lower their take rates or open up the platform to third-party billings, that's going to hurt their high-margin services revenue.
What do you think a resolution would look like? I mean, could we imagine them actually spinning off the App Store as a separate business?
Very unlikely. I mean, it's so hard to decouple App Store from how Apple's operating system is set up and how, all the devices can interoperate, whether it's your iPhone, your iPad, or MacBook. So I can't imagine them decoupling their App Store. At the same time, what they have to do to convince the regulators is basically a level playing field when it comes to third-party app stores. So right now, there are a number of companies that sign up outside their apps, like namely Netflix, Spotify, because Apple takes a 30% cut for every subscription that goes through their app store. So that's where, they have to show to the regulators that even if companies want to deploy their own app store with their own billing systems, Apple is open to that, and you can move out of the Apple ecosystem to go to Android or any other operating system. So all these changes are what I think will happen over time.
Mandeep Singh, great stuff. As always, he never mails it in. He's in our Bloomberg Interactive Broker Studios. He's a senior technology analyst for Bloomberg Intelligence. Appreciate getting some of his thoughts here. Reddit trading off a little bit in day 2 of trading. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up on 1022 on Wall Street, I'm Nathan Hager. We check the markets all day long here on Bloomberg. Watching the rally take a bit of a breather. Those stocks are still on track for their best week of the year. The S&P 500 is down 3 points. The NASDAQ Composite down 6. The Dow Jones Industrial Average with a decline of 110 points. That's a drop of 0.3%. 6 of the 11 main industry groups are in the green right now for the S&P 500. Communication services, the biggest gainer. Consumer discretionary, the biggest decliner, and dragging that lower, Lululemon and Nike. Lululemon shares are down nearly 18% on slower U.S. store traffic and a weaker outlook. Nike is down 8.33%. A sales squeeze is expected for the first half, and Nike is a Dow component. 10-year Treasuries up 13/32, the yield 4.21%. NYMEX crude is down about 0.5% at $80.64 a barrel. COMEX gold's down about 0.5% or $10.30, trading at $21.9620 per ounce, so just below the 2,200 handle for gold. The euro trades at 1.0820 against the dollar. The yen is at 151.22. The slide in Bitcoin continues down 4%, trading below 63,000. That's a Bloomberg Business Flash. Bloomberg Intelligence continues with Paul Sweeney and Michael Regan.
All right, Nathan Hager, thank you so much. We appreciate that. Michael Regan and Paul Sweeney here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Yes, Nathan was just reporting, tough day to be a retailer here. Lululemon, Nike, some disappointing numbers. Stocks taking a hit here today. Let's get the analysis, and we can do that with Poonam Goyal. She's a senior research analyst covering all things on the retail space for Bloomberg Intelligence, joining us from Princeton via Zoom here. Poonam, let's start with Nike here. Stock off about 8% here. I guess a tough first half outlook here, and Bloomberg reporting is talking about some competition from upstarts On and Hoka. Talk to us about Nike. What did you take away today?
Sure. The outlook is definitely much weaker than we would have anticipated, but I think they're positioning themselves for longer term growth. So they talked a lot about innovation in the Air franchise that they have and really expanding that to other sneaker silhouettes. And we think that will position them for longer term growth, but definitely there is a softer start to the year. The first half of fiscal 2025 will be challenging. The light at the end of the tunnel is that 2H25 will be better and we'll end the year on a positive note based on their expectations. And I think the real key here is to focus on the product innovation that they're going to bring forward over the coming 12 to 18 months to really see if Nike can continue its journey to maintain its brand lead. It is a $50 billion company, Paul. So when, folks talk about On and Hoka, when you look at the size of the two versus what Nike has, they're still very, very, very small in comparison.
Poonam, I look at Nike and one of the other stocks you're watching, Lululemon today, really the big decliners in the S&P 500. And I wonder if there's any sort of broader takeaway, sort of a macro takeaway to be had here about the health of the consumer, or is this very much, sort of just brand-specific issues for these two, or is there sort of a return to office story still at play with these two brands at all?
I think it's a combination of a multitude of things. So I think the first is that, yes, there is a consumer pullback that's happening. We heard that from Adidas and Puma too with their softer guidance. So that's not necessarily a big surprise that the consumer is pulling back on discretionary spend. And we saw that with better numbers at Walmart and Amazon, where you kind of push for value a little more. On the other hand, you do have to worry about the product, because the one thing that Lululemon said that was interesting is, yes, traffic was down at stores, but conversion was also weaker. And that means that there's something happening with the product. And they did talk about the need to really up their product cycle and replenish to have inventory in stock, because they did see some weakness from that. So I think it's a culmination of a pullback in the consumer, the product, and also that the athleisure market, I think, is still strong. I think there's still potential there globally. I do think coming off from the pandemic that you will have some normalization of a wardrobe where it's going to be more balanced today than it was, let's say, 2 or 3 years ago, where it was probably 80% athleisure, 20% work life. Today, it's probably leaning back to 50-50.
So you'll be relieved to know that I am not a Lululemon customer. But talk to me about fashion. Is it? I mean, it's all a similar type of fabric and fit. So is it just colors and patterns and things like that? How do you change that up? Because I know getting the fashion right is so important, for the companies that you follow.
Actually, Paul, for Lululemon, yes, it's about getting the color and fashion right, but it's also about the fit and the fabric. Their Align pants, which are their best sellers, the biggest sell on that is the way that they fit you. They make you look good. and every woman wants to look good. So that's the differentiator between a Lululemon yoga pant and, let's say, a Nike yoga pant. There is a difference in the quality of the pant that you're wearing and the fit that it has.
Don't kid anyone. Paul's wearing yoga pants right now. Actually, they're dress pants. They have some pretty good. Lululemon has nice men's dress pants. Yeah, I've got a couple pairs of those.
Look at that.
Yeah. Put them back to Nike. One headline I saw that kind of shocked me is that Nike was able to get the sponsorship of the German national soccer team, taking it away from Adidas.
You can't do that.
Which is pretty. Yeah, it's pretty. Shocking for a soccer fan. I mean, you grow up watching Adidas on the shirts of basically every team. But how big of a deal is that as far as that global soccer market for Nike and sort of this rivalry with Adidas and that sponsorship?
Yeah, look, I think it's a big win for Nike because Adidas is a German brand and it has held that sponsorship for, I believe, over 75 years. So to lose that to Nike is a big deal. And it puts Nike on a stronger foothold across the globe in the field of soccer. So we do think that this is a big win for them, but make no mistake, they paid a premium for this. So it wasn't something that they took away at a steal. They definitely paid up for it.
So I did just recently watched the movie with Jordan, and kind of the story about how he got and the relationship with Nike and kind of how that all plays out. But now the dollars are just so much bigger. So, so Punim, as you look across the Punims, I mean the Nikes of the world and the Adidas and the Pumas and things like that, is that still a huge part of their marketing strategy? Is to align themselves with teams, with individual players? Is that still as big as it always has been?
It is as big as it's always been, but now it's harder to come up in that playing field with some of the major players unless you have deep pockets. So really only Nike and Adidas can afford to spend the money that they're spending to win these leagues and their players. These smaller companies like Puma you mentioned and Under Armour, they're making a bet on rookies. So you saw the success that Under Armour has had with the Curry franchise, and that bet was made a long time ago. You're not going to see these smaller brands chase after the established bigger players and the bigger teams because they don't have the pockets for it. And that's where Adidas and Nike win, and that's what makes them really keep their number 1 and number 2 positions in the global sportswear industry.
Well, Punim, how about all the other sort of also plays out there? Is there any sign of the dominance of these two companies being threatened at all? We see a lot of these sort of Instagram brands, and Amazon brands. Is that a threat to these major players in this industry yet?
I'd say that the industry is broadening, right? So in the sportswear world, traditionally it was all about performance and being on the field playing. Today it's about walking the roads and really wearing it in your day-to-day life. So competition is growing. And there is also competition growing on the performance side with the Hokas and the Ons. They're very popular shoes, and they've actually taken share in the running category. So I do think that both Adidas and Nike have to step up their game to really add more innovation, but they're still small. So I don't think, Nike is at risk of losing its number 1 position just yet. They win by a wide margin, but it's something to keep an eye on over time.
Punim, let's step away from these two stories here and look at your overall coverage. You follow a wide range of retail. You've done that for decades, one of the top retail analysts on the street. What are some of the stories that you think are interesting now? What are you talking to your clients about these days?
I think we're talking about the consumer a lot, right? The consumer is clearly pulled back, and what does that mean in an election year? So we think the consumer is going to remain soft this year, but we think the consumer is stretching their dollars. So they're looking for value. So value will remain top of mind. But that said, they're traveling. So it's not that we're going into a recession by any means. They're not going to fall off a cliff, but they're spending money where they feel that they're getting the most bang for it. And we think that'll be a trend that we continue to see as this year unfolds.
I mean, is that a Walmart/Target story, or does that steer me to maybe the dollar stores?
I'd say, the winners here would probably be, and what we've seen in the past in the fourth quarter is the Walmarts, right? The Walmarts where you find value and you find a broad range of assortment, and where you have a customer that's more broad-based versus the customer of a Dollar General, where they are more lower income and they are too pressured. Walmart attracts a broader market, and they offer the value that you get.
All right, Punim, excellent stuff. As always, Punim Goyal, senior analyst. She covers all the retail space for Bloomberg Intelligence. We were talking about Nike And Lululemon, some disappointing numbers. Nike off about 8%, but as Michael was reporting earlier, Lululemon off about almost 18% here. So a big pullback here for those two retail names. And the question I think a lot of people, Mike, a lot of investors, when they look at the earnings from a Nike or Lululemon, what does it tell you about the consumer?
That's and it was interesting to hear Poonam talk about that. How it's not just execution, it's not just market share story here. It does seem like on top of everything else, there is a little bit of some either spending pullback or at least bargain hunting.
Yeah, and then you compare
consumers.
that to what you hear from like the cruise lines. They're still packing them.
Yeah, fair
I mean,
point.
so people are spending money. They're just spending a little bit differently than maybe pre-pandemic. I don't know. Still on that experiential track, I guess, if you will. Because again, you think about some of these, the theme park operators, the cruise directors, the hotels, the casinos, still seeing really good traffic. All right, with our news in New York City, here is Michael Barr.
Thank you very much, Paul and Mike. Russia and China this morning vetoed a U.S.-sponsored UN resolution calling for an immediate and sustained ceasefire in the Israel-Hamas war in Gaza to protect civilians and enable humanitarian aid to be delivered to more than 2 million hungry Palestinians. The vote in the 15-member Security Council was 11 members in favor, 3 against, and 1 abstention. Before the vote, Russia's UN ambassador said Moscow supports an immediate ceasefire, but he questioned the language in the resolution. Once again, Congress is racing to pass a massive spending package to avert a partial government shutdown. Lawmakers have until midnight tonight to approve a $1.2 trillion measure. Bloomberg government's Zach Cohen has the latest from Washington.
This latest package that's come out yesterday, and Congress does hope to pass out of the House and the Senate today, would complete the saga of funding for the government at least until September 30th of this year. Funding the government has been an extremely difficult task for Congress this year. This current fiscal year has been bogged down in disagreements on top-line funding numbers, literally how much to spend on each agency, as well as on various policy riders.
Bloomberg government Zach Cohen reports House Speaker Mike Johnson will need 2/3 support to send the bill to the Senate, where it would need consent to pass ahead of the midnight deadline. Governor Greg Abbott is responding to new video that appears to show a group of migrants breaching a barbed wire in El Paso, overwhelming Texas National Guard troops. It said it started when Texas troops tried to corral a group of migrants on U.S. soil. Governor Abbott posted on social media today that he's telling them to put more razor wire back in that area. Round 1 concludes today in the men's NCAA tournament. Yesterday, a big busted bracket. 14th seeded Oakland upset number 3 Kentucky. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Michael Barr. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:40 on Wall Street. I'm Nathan Hager, and we check the markets all day long on Bloomberg. Stocks are pulling back just a bit now, with the S&P 500 down 0.1% or 6 points. The Dow Jones Industrial Average is down 0.33% or 133 points. And the NASDAQ Composite is lower by about 0.2% or 25 points. So a bit of a breather from the rally. With no economic data on tap today, traders are turning their focus back to Fed speak. We got some opening remarks from Fed Chair Jerome Powell during a Fed Listens event today. Nothing on monetary policy, but we did see quite the rally after Chairman Powell this week hinted that the Fed is still on track for rate cuts this year. Former Treasury Secretary Larry Summers, though, thinks Chairman Powell and company are sending the wrong message.
My sense is still that the Fed is itchy fingers to start cutting rates, and I don't fully get it. We've got unemployment, if anything, below what they think is full capacity.
And you can hear more from former Treasury Secretary Larry Summers on Bloomberg's Wall Street Week with David Weston. The full conversation airs at 6 p.m. this evening, Wall Street time, on Bloomberg Radio and television. As for the bond market, quite a bit of buying there, with the 10-year Treasury up 14.30 seconds. The yield down about 5.5 basis points to 4.21%. The 2-year is at 4.59. That's a drop of about 4.5 basis points. NYMEX crude is little changed now, trading at $81.09 per barrel. COMEX gold down about a third of 1% at $2,199 per ounce. Euro 1.0819 against the dollar. The yen 151.15. Bitcoin down nearly 4%, trading right around 63,000. That's a Bloomberg Business Flash. Bloomberg Intelligence continues now with Paul Sweeney and Michael Regan.
All right, Nathan Hager, thank you so much. We appreciate that. Michael Regan, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. All right, Michael, I'm 60 years old. And just in the past few weeks, I've experienced two things for the first time in my life. Number one, bought weed. Got some gummies for a friend of mine. For a friend.
Nice.
So that was fun. The second thing is I had my first acai bowl, which I think of what the kids eat.
Are those two things related there?
I don't know.
Yeah,
They could
got
be.
a little munchies there.
But it's actually very good. The smart people behind the glass were telling me it's like this berry from South America, high in antioxidants. I didn't know I needed antioxidants, but it was actually very good. So now I have to go back upstairs to the 6th floor and apologize to the gentleman who served me because I gave him a hard time, like all I wanted was chocolate pudding.
You're going to be wearing Lululemon in no time, Paul.
Lululemon in no time. So even at this age, get some new firsts going out here. Barry Ritholtz. This is somebody we've been looking to talk to all week. I want to know if he's buying off on what the central banks are selling here. Barry Ritholtz, host of Masters in Business on Bloomberg Radio. He's also founder of Ritholtz Wealth Management. He joins us via Zoom. Barry, are you buying what the central bankers are telling us, which is we've got this inflation thing under control. We're still going to remain dovish here. That seemed to be the tone here.
Yeah, I'm buying it for a friend. I'm buying what they're saying for a friend. Absolutely. Look, there's two ways to look at what's going on with the Fed. One way is they keep telling us what they're going to do, and then they go out and do it. And everybody seems to be surprised. They're looking at the data. They know owner's equivalent rent is on a 6-month delay, and that's the biggest component of the recent, what some people are calling a resurgence in inflation. Inflation is down from 9 to 3% in the BLS models, but in the real world, it's down from 9% to 1.5%, 2%. When we look at pick your favorite index, the Zillow index, the apartment list index, rents have not only stopped going down, but stopped going up, but started going down. So, the great post-war inflation surge, post-COVID war inflation surge is over. And please, can we stop using the 1970s as a parallel? It's the post-World War II 1940s. That's your frame of reference.
Hey, Barry, there's one story I just noticed on the terminal, really lighting it up as far as readership. I'll give you the headline. Bill Gross laments, quote, excessive exuberance as stocks surge, channeling his inner Greenspan there a little bit. And, to your point, I think there is plenty of rational reasons to be at least happy about the market, if not exuberant. But at the same time, valuations are high. S&P's up 10% year to date, and you're still able to get a positive real yield even on cash these days. How does all that sort of add up to how you think about allocations at this point?
Sure. Well, let's take the economic backdrop that we're looking at and see if there's any reason for people to be, exuberant. Net worth is at all-time highs. Stock prices are at all-time highs. Home prices are close to all-time highs. Economic activity, GDP, all-time highs. When you look at consumer discretionary spending, especially things like air travel, all-time highs. And if you're concerned about valuation in stocks, well, I'm getting 5.3 on my money market account. After 15 years of begging for 2 or 3%, muni bonds have a tax equivalent yield of about 7.5%, 8%. So it's not like, wow, everybody has lost their mind. There's no reason to be happy about the market. There are good reasons for the exuberance that's out there. And let me remind people, nothing in the universe is more bullish than stocks at all-time highs. If you only invested on days when stocks made all-time highs, you outperform every other date of investing. It's shocking, but it's true. When markets make new all-time highs, they tend to continue going up. Think about what happened in early 82 when markets breached the highs that were made 16 years earlier in 1966. Or look at 2013, March 2013. Each of these cases led to decades in the 80s example of increased rising markets. The economy is good. Consumer have money in their pocket. By the way, 5.25, about the average Fed rates for the past 40 years. We were just spoiled by zero in the post-financial crisis era. So if they do what they say and take 2 or 3 quarter point cuts down, I mean,
hey Barry,
this is Goldilocks.
If the economic data says things are really good, stock market, housing prices, GDP, all that kind of stuff, why don't all the political polls say everybody thinks the economy is terrible and I'm worse off than I was 4 years ago and blah 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 blah? What's the disconnect?
I'm so glad you said that. I'm so glad you asked that. So
Asking
in
for a friend.
2022, in 2022, when inflation surged, we saw the Michigan Consumer Sentiment Poll drop to below levels that we saw during the 87 crash, during the dot-com implosion, during September 11th, during the financial crisis, and during the pandemic. That makes no sense. And there's really 2 explanations for it. One of it is economic, and the other is sort of political. The economic answer is, despite when I talk about all these all-time highs, to be fair to the broad economy, that's mostly true for the top half of earners or wage earners or wealth holders. Because when you look at the bottom half of the economy, we are clearly a bifurcated economy. And if you have a college degree or better, you're doing really well. Your 401k is up, your house price is up, you have discretionary cash. If you don't have a 4-year degree, if you're in the bottom half, and by the way, that 4-year degree metric comes from Sir Angus Deaton, who won the Nobel Prize in 2015 for his work on income inequality and poverty and well-being. There's very much a have and have not sort of society in the United States. It's true around the world, but it's especially true in the United States where, if you look at the UK, they have guaranteed health care and retirements. And so the stress levels in the bottom half are much worse. So that's the one half of it. The other half of it is, I don't know who's answering pollster phone calls or online surveys, but it's just not representative of the country. It's
right.
It seems to be people are trolling pollsters.
Yeah. All right, Barry, great stuff. As always, always appreciate getting a few minutes of your time. Barry Ritholtz, he's host of Masters in Business on Bloomberg Radio. That's a podcast, really, really popular. He gets great guests. He's also the founder of Ritholtz Wealth Management. That's his day job. We're going to have more coming up. This is Bloomberg.
The way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Devices in China. That's according to the Wall Street Journal. It says because regulators there have to vet all AI models. Baidu is considered one of China's leaders in developing homegrown answers to ChatGPT. Baidu shares a little change to the upside. As for Apple, it's up about 0.4% after falling 4% yesterday, with the Justice Department announcing an antitrust case against the tech giant. Tesla is cutting production at its Shanghai plant as it faces sluggish sales growth and intense competition in China. Sources tell Bloomberg News employees have been told to work 5 days a week instead of the usual 6.5. Bloomberg's Alex Webb says this could point to a strategy shift.
Last year, when Tesla started to see this weakness in the EV market, it started really pushing discounts in order to drive its numbers up. Don't forget, Tesla massively expanded its capacity in recent years with new factories in Berlin, in Texas, and of course in Shanghai itself. In order to fill that capacity, it really started discounting in a big way. This might signal a bit of a pivot.
Bloomberg's Alex Webb. Those are some of the company stories we're following this hour.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, a little quiet Friday here after the good trading we've had all week on the backs of some Federal Reserve, of central banks, including the Federal Reserve, giving a little bit dovish outlook. Let's be clear on that. S&P 500 today is off 0.2%. The Dow's off 0.5%, and Nasdaq's off about 2.2% here. So we'll keep an eye on that. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Mike. The United Nations Security Council failed to pass a resolution this morning calling for an immediate ceasefire in Gaza as part of a hostage deal after Russia and China, who are permanent members, vetoed the measure proposed by the United States. UN Ambassador Linda Thomas-Greenfield spent the morning urging United Nations states to get on board with the resolution, but her pleas did not work.
This is a strong resolution. It's the byproduct of exhaustive, inclusive negotiations. It reflects the consensus of this council. And it does more than just call for a ceasefire. It helps to make a ceasefire possible.
The vote on the resolution was 11 in favor, 3 against, and 1 abstention. Meanwhile, Secretary of State Antony Blinken has met with Israeli leaders in Tel Aviv on the final stop in his 6th urgent trip to the region since the start of the war. The U.S. has urged Ukraine to halt attacks on Russia's energy infrastructure, warning the drone strikes risk driving up global oil prices and provoking retaliation. It comes as Russian drone and missile attacks have hit Ukrainian power plants. Members of the far-right House Freedom Caucus are railing against fellow Republicans for supporting a bill that will prevent a partial government shutdown. The House is expected to vote on the $1.2 trillion spending package today, barely 24 hours after it was introduced in Congress. Lawmakers have until midnight to avoid the partial shutdown. The measure has the support of President Biden and leaders in Congress, but on Capitol Hill today, House Freedom Caucus Chairman Congressman Bob Good of Virginia said Republicans are violating their own 72-hour rule.
You know, we don't need 72 hours to vote against a bad bill, but you would think if you're planning to vote for it, you might want to actually know what policies you will own by the virtue of your yes vote on that bill.
GOP Representative Bob Good. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Mike.
All right, Michael Barr, thank you so much. We appreciate this. All right, so Michael Regan here. We have the House voting as we speak on a $1.2 trillion plan to fund, I guess, the government, a lot of these agencies, until September 30th. Now, if and when they announce this passing, we'll have some cool reporter come on, smart reporter from Washington, D.C., tell us what's happening. But we don't have to pat these folks on the back, do we? I mean, aren't they just doing their job?
Well, one would think, yeah. I'm not sure there many back patting is deserved down there. But, hey, at least they're able to keep the government open.
Is that where we are? We're just like, hey, at least they're able to keep the government open.
I still think, I think there is a chance that it could shut down over the weekend if they don't get it through the House in time for the Senate to vote on it. And you know, there are some procedural things that certain lawmakers could put through to keep it from passing until Monday. So we might even get a little bit of a shutdown over the weekend, though I'm not sure anyone will notice. Maybe the Smithsonian's closed, that type of thing.
Right, interesting. All right, some interesting news that I talked about earlier today, which I know will be interesting to our listeners. Jerry Seinfeld, according to the Bloomberg's analysis, he's a billionaire.
Yeah, it's amazing.
The syndication revenue off of that show's like, you know, close to $500 million over since the life of the syndication life, and it's still going strong. They're still inking deals with like Netflix and things like that. So
it's one of those timeless shows, you know, that lives in reruns permanently almost. You know, so I'm almost surprised it took him this long to become a billionaire. But then again, he's kind of just relaxed since that show. I mean, he had the comedians in cars drinking coffee, but he hasn't really been, and the B movie, that sort of thing. But he hasn't really been out there earning. So I guess it's just
like Larry David's out there with Curb. 14th season. I think the last season here.
Yeah.
It's sadly pretty good. So heck of a show, and it just shows you the value of syndication, man. And it's not what you make. And he made a ton of money when it was running on air, but syndication, maybe that's how it works. Well, more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Lee Klaskow, he covers all the railroads, the trucks, all the logistics, the air traffic companies. I saw him walking around Bloomberg's headquarters here in New York, so we grabbed him and pulled him into the studio. In a couple of minutes, we're going to talk to him about FedEx and what's happening in the world of FedEx. That stock had some big moves here on some earnings. It's also Friday. That means it's Munis in Focus. We'll talk to Eric Kazatsky, Bloomberg Intelligence. He covers all things on the Muni side. Then Steve Mann, global auto analyst, industrials research analyst. He was based in Hong Kong for many years. We've got him back in our Princeton office. He covers the global auto industry. I want to figure out what's going on with Tesla. They're cutting production. I'm just not sure what's happening with Tesla and this whole EV thing. So where's that demand really ultimately for EVs? So we'll check in with Steve Mann on that. But first, let's go to Nathan Hager and get a Bloomberg Business Flash down in Washington, D.C.
All right, Paul, thanks. It's brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. So we've had 20 record closes for the S&P 500 this year. Is today going to be 21? At the moment, markets point to not yet. We're seeing a little bit of a pullback after the record close yesterday, but after the Fed hinted at rate cuts still on track for this year, Invesco Chief Global Market Strategist Christina Hooper says monetary policy will keep driving this market higher.
Sentiment has gotten more positive because we know the end is in sight and that we're going to start to see rate cuts. In fact, the Swiss National Bank gave us a nice surprise this week, our first present in terms of cutting. But this is just the beginning.
And we are expecting more Fed speak today. In fact, we did hear from Chairman Powell again at a Fed Listens event. Nothing on monetary policy, though. We're also scheduled to hear today from Fed Vice Chair for Supervision Michael Barr and Atlanta Fed President Raphael Bostic. But before all that, we are seeing a little pullback in the market. We check it for you all day long here on Bloomberg. And right now, the S&P 500 is down 8 points, or about 0.2%, 52.33 is the S&P level. The Dow Jones Industrial Average down 174 points, or 0.4% at 39,608. The NASDAQ Composite, little change to the downside, down 14 points at 16,388. 10-year Treasury up 12/30 seconds, bringing the yield down to just about 4.22%. The 2-year yield is at 4.59. NYMEX crude's down about 0.2%, trading just shy of $81 a barrel. COMEX gold down 0.5% at 21.9510 per ounce. The euro 1.0816 against the dollar. British pound 1.2604. The yen 151.29. And Bitcoin's decline continues, down 3.8%, trading just shy of 63,000. That's a Bloomberg Business Flash. Bloomberg Intelligence continues with Paul Sweeney and Michael Regan.
All right, Nathan Hager, thank you so much. We appreciate that good stuff here. Again, we're seeing a little bit of a pickup in the selling here. The Dow's off 0.4%. That's 168 points, but not a whole lot happening here. So let's check out Norma Linda, though, because she's a markets reporter. It's her job to go look at what's happening in the markets. What are you looking at, Nora?
Well, let's look back at Lululemon. This is the biggest decliner in the S&P 500, seeing its worst day since March of 2020. Those shares are down as much as 19%. Now, there was a beat on the quarter, but its sales outlook is what investors are really looking at. It came in pretty cautious. It said that it estimates $10.7 billion to $10.8 billion in terms of its sales outlook, representing growth of 11 to 12% versus the 19% that it had in the previous year. The CEO essentially said that its U.S. stores have slowed down in terms of the traffic that they're seeing versus the prior year. Morgan Stanley says that the company's underwhelming performance in North America and disappointing sales guidance has further fueled the bear narrative here.
Lululemon? Are you a Lululemon customer?
I do not shop at Lulu.
Where do you go? Because Poonam Goyal, who from Bloomberg Intelligence, was just on making the case that Lululemon is in fact different from fit, quality, all that kind of stuff versus the competing kind of
I've heard that they have really good quality stuff. I mean, I will say my mom did buy me some stuff from Lululemon back in the day, but I don't really shop there myself. I know they've gotten a lot of backlash on the social front in terms of like their execs and everything. At least that's what I see on TikTok. Who knows what to believe?
Well, if it's on TikTok, it must be true,
Right,
right?
it has to be.
It's got to be, yeah. They wouldn't put it on there otherwise. It's strange. I'm the only Lululemon consumer in this group.
Are you?
Yeah. And hopefully it's not the form-fitting Lululemon.
No.
I don't want to go there.
No. Just the regular dress.
I didn't think they had regular
Nice
stuff.
pair of regular dress
Really?
pants, yeah.
All right, you learned
My wife
something
got
else.
them for me one time, and I liked them
And
so
they're
much.
comfy?
Yeah.
Good.
A little stretchy, you know. It's the sizing's weird. You buy a 34, but it's a 33 waist. I don't really get it.
But I need to go the other way. Yeah. What else you got?
Looking at Best Buy, so those shares are up earlier as much as 3.6%. This is the second biggest gainer in the S&P 500 by percentage. This comes after JP Morgan raised the stock to overweight from neutral and hiked the target to $101 from $89. It says that headwinds for the company should moderate in the second half of the year for computing, TVs, and appliances, and that its margin outlook is conservative as long-term margins are well off of their potential. This is really a nice continuation, especially as we think about last month when it had its earnings and it reported that it showed a reversal in its 2-year slump in sales demand. So maybe people are out there getting computers and things.
All right, good for them. I mean, I don't know. I haven't bought anything new on that front. I mean, I just got my phone.
Just gummies for you.
What's that?
Just the gummies.
Yeah, just the gummies for me. That's all. That's all.
Don't
I
they
need.
have like a Geek Squad or something? I want to say.
Is that Best Buy?
Yeah.
Is it Best Buy where I think you walk in there and you can bring in your tech and they fix it?
Yeah, Geek Squad, yeah.
Yeah.
Good. What else? All right, last. What else you got?
Well, I know you guys are going to be talking about FedEx a bit
We
later.
got the man.
Yes. This is the biggest gainer in the S&P 500, trading at its highest level since 2021. It's surging on plans to buy back $5 billion of its shares as its cost-cutting efforts are really paying off. Also, TD Cowen said that as well, saying that the company's measures are really paying off. The CEO's restructuring process has really been in focus, especially as they're shrinking the workforce. And this is the third straight quarter that FedEx's operating income has risen despite falling revenue.
All right, Norma Linda, thank you so much for joining us. Norma Linda, she covers all the markets for Bloomberg News here. Let's get right to it. Lee Klaskow in the house, darkening the door. Whenever we see him walking around, we just grab him, because it's a long walk for me down to Princeton. So anyway, Lee, you've been covering FedEx forever. You've been covering all these logistic companies, the rails, the trucks, all the shippers. You know this stuff end to end. FedEx seems to me to be a core story within that global logistics. What went wrong, and then what have they been doing to fix it?
Yeah, so FedEx is a great story, and it's an improving story. And the reality is that over the years, it got too big for itself, and it got too fat. And there was a lot of hesitation to combine its network. So as an air network and a ground network, its ground network is mostly independent contractors, and its air network are employees. So it's not easy to integrate those networks. And a lot of analysts have always said we should integrate them, and management would say, you guys don't understand our business, we can't do that. Well, fast forward, they're doing it, and that's their tricolor strategy, where they're, which is redesigning their air freight network, and they're also combining their express and ground and services business into one segment, if you will. It's pretty much everything, but they're less than truckload business. So they're doing a lot on.
This sounds like a good old-fashioned. We got to restructure our business.
Yeah, and they're gonna emerge as a lot more efficient. They're gonna emerge as a lot more profitable, and that's the hope. Their express network has really poor margins. I mean, their margins were 2.3% in the quarter, and that was real good outperformance in what the street was expecting by over
I'm
110
looking at
basis
PGEO
points.
function.
Yeah.
I'm seeing that. Very good. Okay, the numbers are good.
Yeah.
Okay. All right. So what's next steps for them?
So, as you heard earlier, they announced a $5 billion stock buyback plan. I think that gives people confidence in management's ability to execute. Execution risk is really the number one concern I think the street might have. As you probably saw in the Bloomberg terminal today, everyone's raising their price targets and their estimates for fiscal 2025 and beyond. And that's really driven by, they're cutting about $1.8 billion in costs this fiscal year, and they're going to do about $2.2 billion next. And if you think about it, $1.8 billion is about $5.75 per share, and this is a stock that was generating $15 in EPS. So these are sizable increases in the overall profitability of the company. Management, they've stumbled here and there, but it really seems this last quarter that they're executing and they're focused and they're building confidence. And sentiment is so important when it comes to FedEx, which has struggled in the past.
Lee, when you talk about saving, cutting costs by that degree, I mean, I assume that's mostly headcount to some degree. Where are they cutting jobs? Is it just redundancy between the separate units now that they're combined? A company like FedEx, it seems like it'd be tough to cut those union jobs, the drivers and that sort of thing. Is it middle managers that are getting the pay slips?
FedEx is a non-union shop, except for its pilots. Its pilots are union.
Their drivers are non-union. Okay.
The drivers, most of their drivers that come to your house are actually, they don't work for FedEx.
Gotcha.
They're independent
UPS drivers are union, right?
Correct.
Okay,
They're the Teamsters. So where are they cutting heads? Well, they're not really cutting that deep. What they're doing is they're getting rid of middle management. Like I said in the beginning, they've gotten a little fat, so they're getting rid of some middle management. A lot of that is through attrition, some natural attrition. It's not like what was the guy's name, Jack the Chainsaw guy coming in with destroying companies. I think it's going to be more of a gradual shift. And as they combine networks, they're going to figure out where the redundancies lie, and they're going to benefit from reducing those redundancies. And that's through their Drive initiative and their Network 2.0 initiatives that they have out there.
Has FedEx or UPS or any of the other global shippers, have they talked about problems getting planes because Boeing's in the news every day. Unfortunately, we have to talk to George Ferguson every day because Boeing's always in the news. Has any of these companies ever said, we're not getting the planes we need for our fleet?
No, that's not a problem because what they're doing is they're actually, FedEx is trying to downsize its fleet because with this whole redesign of their air fleet, they're going to need probably less planes over time. And those planes that they're going to be operating are going to be operating much more efficient. They're going to have a lot more density. When you talk about freight and transportation networks, it's all about density, how much stuff you have in, whether your truck or your train or your plane. And so that's going to be key for them to drive those margins higher in the express business.
Lee, I've read that there's a lot of sort of R&D looking at the automation of package delivery. Or is there a chance in our lifetime that we'll see, sort of driverless vehicles dropping our packages off, that sort of thing?
I'm not a huge bull on like autonomous trucks or delivery.
Why not?
But what they will be doing is they will be leveraging technology and AI to make sure a package gets into the right network and gets and it has that delivery promise that they have, whether it's overnight or deferred. What they're really going to be doing is using technology to make sure that package gets into the right network.
Yeah, but you don't think the technology is going to be there to actually have a driverless type of delivery?
Not anytime soon. Maybe little niche markets they might have, and kind of just highlighting those little robots that
drones
that go around towns, and you see pictures of people beating up the poor little robots,
right,
knocking them over.
Exactly. So during the pandemic, Lee became, for better or worse, kind of our supply chain guru. It discovers all the companies, like the shipping companies that get the stuff to our shore, then the rails that take them into middle America, and then the trucking companies that deliver them to everywhere, and all that kind of stuff. So let's start with the rails here. I'm looking at the trailing 12 months. These stocks have done pretty well. I mean, they're all up mid-30s%. Norfolk Southern, CSX, Union Pacific. Pretty good performance. What's the story for the rails these days?
Yeah, there's really not a homogeneous story with the rails. Okay. Interestingly enough, it's really company specific. Norfolk Southern, it's all about activist investors. They're dealing with Ancora, which is trying to kick out management and put their own precision scheduling railroad management team in. Norfolk Southern has come back and said, we have our own guy that we want to put in from PSR. Some investors might be, well, it's a little too late. You should have done that a couple of years ago. So no matter who wins the battle, Norfolk Southern will emerge as a much more profitable company. And then Union Pacific, another story. They had a change in CEO. Jim Vena is a PSR, precision scheduling railroading guy. And for those out there, PSR is really just Six Sigma for the railroads. It's just operating really efficient networks, sweating assets, that sort of stuff. He's coming in and he's got his own vision of how that railroad should operate. And then the littlest one, even after a merger, Canadian Pacific, Kansas City. They have their own growth story because now they are the only railroad that goes from Canada into Mexico.
Yeah, that's a great story.
And so they are the only railroad that is probably going to grow earnings in this last quarter, the first quarter.
How about the truckers? I'm looking and I put up JBHT. That's the ticker I always remember. And you hit the BQ function. It gives you the relative valuation relative to all its peers. Truckers not doing as well. I'm looking at JBHT over the trailing 12 months. It's up 18%, but some of the others are down. What's the word on the trucking biz?
So trucking has been not great, and that's really just too much supply out there, and that excess supply is killing the truckload spot market, which is down, mid-teens from last year. And that is weighing on contractual rates, and that's where most publicly traded trucking companies play. Some pure play truckload carriers are like Heartland Express. Knight Swift is a major truckload carrier, so is Werner. But a lot of them don't play in that really volatile spot market business, but it does impact their overall earnings ability. And a lot of them have been diversifying into less volatile businesses. Werner, for instance, is a big dedicated carrier, so it's more like they'll go to Walmart and say, we're going to haul stuff for you between Chicago and New York. We'll do 10 trucks a week, or between DCs and retail stores, and they sometimes load the shelves at CVS, some dedicated services. So that's one area. Freight brokerage, which is obviously non-asset and higher ROIC, which is attractive to a lot of them. And when you started with JB Hunt, their trucking company is their trucking company business is probably one of their smallest segments. It's really an intermodal provider, and a brokerage provider, and a dedicated provider.
Lee, the other getting back to FedEx, the other big headline was this $5 billion share buyback.
Yep.
Is that what you think has investors excited, or is it more the actual execution and the performance?
I think it's actually both. I think they wouldn't have said $5 billion if management isn't confident on their ability to execute. Like I said, execution risk is high because things happen. A lot of transportation companies like to say their businesses are outside sports. You have weather to deal with, and that was something that was really interesting during the quarter. FedEx, their express business and their Memphis hub, which is their biggest hub, dealt with a lot of bad weather, and they were able to, it really didn't impact it that much. And a lot of people were expecting low margins on that express business of around 1% because of the weather. And again, they exceed that expectation by around 110 basis points.
All right, so now step back. We'll put it all together. Supply chain. Is it fixed? Are we back to new normal? Are we back to a new normal? If I order something, or more importantly, a retailer orders something, they expect to get it by a certain date. Are they going to get it by that date?
Yeah, and like the biggest risks looking forward is that the East Coast ports are negotiating with their labor. That's in September that contract comes due. And so what you could see is some work stoppages, God forbid a strike. And that's putting a lot of retailers and shippers on notice. They might be moving freight to the West Coast. They might start ordering for peak season a little earlier. So peak could be a little lumpier, if you will, start a little earlier. So I think that's the biggest risk, I guess, down the road. Obviously, the geopolitical stuff we can never guess when that's going to hit the fan.
During the pandemic, we had Gene Soroka, who runs the Port of LA. He was on our show a lot. He was really helpful in understanding kind of where these ships are from China. Where are they going? How long do they have to sit out there in port? And during their work issues, I guess I'm not sure if they actually had a strike, I can't recall, but they lost some business to the East Coast ports.
Right.
And, he's been coming back here and kind of trying to get that business back for LA. So it is competitive between ports. But now, I can't even get through the Panama Canal easily, right? Because I got a water problem there.
We got low water.
Go fix that. You got to get you down there to fix that. I mean, what do you do with the low water in the Panama Canal?
Start digging, I guess.
Rain dance, maybe.
But that's a real issue, right?
Yes, it is. And what happens is that the ships that normally traverse across the Panama Canal can do so, but they can do so with less freight in it, so it weighs it down because the canal is more shallow. So there are ships going through, but those ships are carrying less freight, and so therefore the cost per ton of whatever you're shipping increases. The Suez Canal is probably more of an issue of what's going on there with the Houthis.
Is anything going through there these days?
If you're a Chinese ship or an Iranian ship,
really?
or a Russian
ship, they'll let you go
betcha.
through.
Oh, they'll let you go through.
Yeah, they came out and said yesterday they won't touch them.
Yeah, and obviously the Houthis are aligned with the Iranians, and the Iranians are partners with the Chinese and the Russians. So they're able to traverse through there.
See, I'm telling you, logistics, supply chain, it's fascinating to me. And you know what? I totally, during business school when we had that class, I skipped it probably half the time to go across the street and play the Duke golf course.
It was one of those things that no one really worried about until it was crisis time.
Right.
And I mean, Lee obviously worried about it, but Lee, how do you think sort of, now that we're on the other side of the pandemic, it was such a crisis with logistics and supply chains.
Right.
Is there a legacy, no company wants to sort of fight the last war, but are there sort of permanent changes that you can look at and say, these companies have been able to eke out some efficiencies or something about their business that they learned a lesson from these supply chain issues that they'll carry forward?
Right. Well, the changes that we're seeing is an increase in nearshoring and de-risking. And the reality is that this is not going to happen overnight. It's going to be like watching grass grow. It takes a long time to put a new facility up in Mexico or even the United States for that matter. So I think you're going to see more and more of that. And that's a net positive for the domestic transportation companies. It's a net positive for, like I mentioned earlier, Canadian Pacific, who has operations in Mexico, Werner, who does a lot of cross-border business across Mexico. So these are companies that will definitely benefit from that movement. And it's a long-term, slow, secular growth story for transportation.
All right, Lee, great stuff as always. Always appreciate getting your time. Lee Klaskow, he's the Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. We are waiting for the reporting on that House vote. Got a couple shekels they're trying to get passed here to keep this government funding funded and open. So we'll bring you that vote as it happens. Should be in just moments. We'll have some reporting there. In the meantime, let's head down to Washington, D.C. Nathan Higger's got some updates for us.
Yeah, watching the money moves on Wall Street. We check the markets all day long here on Bloomberg. Paul, we're seeing a little bit of a pullback from the bull run. Best week of the year for stocks. S&P 500's down 0.1% or 5 points. NASDAQ Composites, little change to the downside. The Dow Jones Industrial Average seeing a modest decline, down 152 points. That's a drop of 0.4%. Consumer discretionary real estate among the biggest laggards in the S&P 500 right now. Biggest drag on the Dow. You can pin that on Nike. Those shares down 8% with sales squeeze expected for the first half. The company is expecting even more competition from running shoe upstarts like On and Hoka. Right now, the 10-year Treasury is up 14/32, yield 4.21%. The 2-year is at 4.58. NYMEX crude's down 0.25% at $80.87 per barrel. COMEX gold down 0.6% at $21.9240 per ounce. Euro 1.0820 against the dollar. The yen 151.25. Bitcoin's back above 63,000, still down about 3% on the day. And that's a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, the focus on munis today, it is brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be a part of building America. Invest in, bam, insured bonds. I heard Matt Miller all the way from Westchester yelling out, bam. All right, Eric Kazaski, you're up, buddy. This is your turn. Eric Kazaski, he's a senior municipal strategist for Bloomberg Intelligence, joining us from Princeton via that Zoom technology, which is just amazing. How great is Zoom? All right, so Eric, what do we got here in the municipal bond market? I've got central banks around the world telling me they're staying on this dovish track here. What are you seeing in the muni market?
Yeah, I mean, talk about dovish. I mean, we are all about lower rates in the muni market, and not because of anything the Fed is doing. It's just really because people are scared of higher taxes. And as we get closer and closer to the election, I think you're going to hear that drumbeat even more. You know, a lot of people in the muni market are worried about state taxes going up, even more concerned about some of the rollbacks and the provisions of Tax Cuts and Jobs Act that could force the federal tax rate to pop up again.
You know, Eric, I've read that one thing that's really helping the muni market this year is a lack of supply of new issuance, especially in that high yield area. What's causing that? I mean, are munis issuers sort of reactive to higher rates and they pull back, or is there something else going on?
Yeah, I mean, to some degree. I mean, look, we're in an election year. There's a lot of volatility, a lot of uncertainty regarding, you know, what the tax regime is going to be, what the tax, you know, what any sort of regulations are going to be going forward. So I think there might be a reticence to just kind of like take this year a little bit slower. You know, looking back over the last 6 years, you're right. High yield muni issuance is probably at the lowest levels we've seen to start the year. And that's been pretty much a primary driver of where performance has been. Just comparing across the board, high yield munis solidly outperforming IG munis by about 100 basis points. So, you know, really positive there.
So